Good afternoon, everyone. On behalf of Echelon, I would like to welcome everyone to our conference. The thematic that we've chosen is Canadian growth company, heavily exposed, meaning most of revenue and operating profit being generated from a strong post-COVID US economy. So in that context, we're pretty excited to introduce 5 companies that offers this exposure, namely Converge, Wildpack, BSR REITs, Hamilton Thorne, and High Tide. And just as a reminder, we encourage questions from the audience to our guest speakers. To that effect, we've set up a chat function that lets you ask questions anonymously. And with that, over you, Andrew, with High Tide. Thank you.
Great, thank you for that introduction, PY, and good afternoon, everyone. It is my pleasure to introduce our first presenter for today. That is Raj Grover, CEO and founder of High Tide. High Tide shares are traded under the ticker symbol HITI on the TSX Venture, and most recently, just of last week, also on the NASDAQ exchange. High Tide is a leading North American retailer, distributor, and e-commerce provider of adult use cannabis products, hemp-derived CBD products, and related accessories. Raj has led the business through an exceptional period of growth where High Tide has outperformed operational and financial objectives. The last 6 months in particular have been transformational for the company as High Tide secured the capital needed to rapidly expand its business. The bolstered balance sheet has helped to uncover an emerging US M&A strategy where we believe there's long-term potential to consolidate complementary businesses in the US at very attractive valuations and benefit from robust organic growth ahead. With that, I'd like to turn the call over to Raj to discuss the business of High Tide and the tailwinds we could expect to see as the economy continues to reopen. With that, over to you, Raj.
Thank you for that introduction, Andrew. Appreciate it. Hello, everyone. My name is Raj Grover. I'm the founder, president, and CEO of High Tide Inc. I started the company in 2009 with a total investment of $48,000 with 2 employees. And today we're one of the most unique and diversified cannabis ecosystem in North America. We are a retail focused company. And with that, I'll move on with the presentation. This section here is for the lawyers in the group. So here's a company snapshot. Like Andrew mentioned, we trade on the TSXV and on the NASDAQ now under the ticker symbol HITI. And in Frankfurt under the ticker symbol 2L/A. We became the first publicly traded cannabis retailer anywhere to be approved for trading on NASDAQ. We started trading on NASDAQ on June 2nd. Our shares outstanding today are 49.5 million. Market capitalization is sitting at approximately 491 million. And today we've grown from, in 2009, from 2 employees to 825 employees as of last week. I'm going to be going a little faster than usual in this presentation because of the time we have. We only have 30 minutes, including Q&A, so it'll be generally a bit faster than I usually like to go. So our business is divided into 2 main segments. One is retail and one is wholesale. In retail, it's divided into bricks and mortar and online. So in bricks and mortar, we do our business in Canada. We have 87 retail cannabis stores in Canada. In Alberta, BC, Ontario, and Saskatchewan, in Alberta, Manitoba, Ontario, and Saskatchewan, hopefully soon to be BC. Majority of the stores are under the Canna Cabana brand, which I will explain more in the slides that are coming up. Remaining brands are New Leaf, Kush Bar, and Meta Cannabis Supply Co., which are all being consolidated in Canna Cabana as we speak. And then moving on to the online side of things, we acquired a business called grasscity.com in December of 2018, which is one of the oldest online smoke shop of smoking accessories in the world. It carries about 6,000 to 7,000 SKUs on its platform. It was a vertical integration play for us as we are also the manufacturer and distributor of many of these smoking accessories. To be precise, we manufacture about 75% of all of our product catalog in-house. We followed that up with the organic launch of CBD City in May of 2020. From which we gained many valuable insights. And then we ended up acquiring fabcbd.com in May of 2021, which I'll also talk in the next few slides. And then moving on to our wholesale business, We're also a global designer, manufacturer, and distributor of proprietary and licensed smoking accessories. We also have relationships with celebrities such as Snoop Dogg, Trailer Park Boys, studio brands such as Paramount Pictures and Sony Pictures, and also artists like Guns N' Roses, which I'll also explain on future slides. Valiant Distribution not only takes care of our in-house product strategy for our own chain, but we also sell wholesale to other smoke shops and other retail channels, upwards of 3,000 stores worldwide now. So our company has been totally transformed over the last 6 months. As you can see, 6 months ago, we're sitting at around 66 stores. We're now at 87 stores as of June 7th. Our revenue has increased from 70 million 6 months ago to now a run rate of 175 million. Our trailing EBITDA was sitting at -2 million. That's gone up to positive 13 million over the last 4 quarters. We became the first cannabis company in Canada, retailer in Canada to declare positive adjusted EBITDA, which was Q2 of 2020. And we followed it up with 4 consecutive quarters of positive EBITDA. Our US run rate has increased from 22 million to 40 million with our most recent acquisition of Fab CBD. We've also tremendously strengthened our balance sheet. Our cash balance has increased from 21 million to approximately $33 million today. And our debt has been cut off from 72 million to approximately 32 million. We just announced it yesterday that we've eliminated all of our senior secured debt, bringing our debt down to only $32 million now. And there's only $3.8 million of immediate debt that's due within the next 12 months. So we're very comfortable in terms of our balance sheet. Our capital markets profile has also been turned upside down. We were trading on CSE just a few months ago, or about 6-7 months ago. We transitioned to Toronto Stock Exchange Venture, and then from OTC more recently to NASDAQ, opening up to more reach to institutional and retail investors. We also trade a lot more than what we used to. We were trading around $300,000 a day about 6 months ago, and now we trade around $8.1 million a day. Our market cap has increased from 79 million to 491 million over the last 6 months. You can see some of our recent financial highlights here. Our revenue in Q1 of 2020 was only 13.7 million. You can see the trajectory there. In Q1 of 2021, we put out 38.3 million. So a really nice increase there. Same thing with adjusted EBITDA. Q1 of 2020, we were looking at negative 821,000. And we've had 4 consecutive quarters of rising adjusted EBITDA from 1.7 million in Q2 of 2020 to 4.6 million in Q1 of 2021, which is the highest amongst our peer group here in Canada. High Tide also, as I mentioned earlier, High Tide became the first Canadian public cannabis retailer to report positive adjusted EBITDA. Total assets of the company are sitting at $166 million. I thought this was important to showcase this slide in our presentation. Unfortunately, the retailers have been grouped in the same bucket as LPs, which are facing many issues as, excess supply issues, shuttered facilities, negative EBITDA. Well, it's totally different metrics when it comes to retailers. We have positive EBITDA, we have positive revenue growth, and we deal with minimal CapEx requirements. To put up a 12 to 1,500 square feet store, we spend anywhere from $250,000 to $300,000 inclusive of inventory to open up a store. And our ramp up periods are only from 3 to 9 months in any of these locations. So it's a very different ecosystem than LPs. But unfortunately, to date, LPs have had all the limelight, and we're sort of grouped in that bucket together. When they are collapsing on their downfall, unfortunately, we're still bearing the brunt of it, but we think this will change in the near future. Our financial performance or financial profile is much better than our peers, and that's simply because of our experience in the cannabis industry and doing business in the cannabis industry over the last 10 years. We have structural advantages due to our ecosystem as we touch hemp-derived CBD products, we touch smoking accessories, and we're also a large retailer with 87 stores in Canada and growing every day. This is our leading cannabis retail brand in Canada. It's called Canna Cabana. I'm very proud to say that 50% of our daily transactions that happen in our retail stores happen through our loyal Cabana Club members. I don't think any of our peers can say this. This is simply because we have a very unique strategy and unique offerings that we present in the store. I'll show you guys that on the next slide. We're also able to monetize our data from these stores. The licensed producers need to guide their growing capabilities and where they're going quarter after quarter. You know, the consumer preferences in cannabis are changing a lot. They're changing very fast, so they need this data. Other industry stakeholders like investment banks also need this data. So we're able to monetize that data from 87 retail stores and counting. This is a very high margin business. Cabanalytics commands around 95% gross margin. So our best margin business in the portfolio. Typically, a Canna Cabana location is around 1,200 to 1,500 square feet. And it costs us around $250,000 to $300,000 all in, including $50,000 of inventory to launch these stores. And these numbers have come down. When we first started, it was around $350,000 to $400,000. Now we have more economies of scales. We have more relationships with GCs and builders, and we brought that price down, which is one of the most competitive in the industry. One very big thing I'd like to mention about our brand, which is very proprietary to our brand, is we consider ourselves the one-stop shop of cannabis. So because accessories was in our DNA since 2009, you know, when you go to our stores, you don't see 3,000 square feet stores with 3 big TV screens, you know, and 3 bud tenders. It's very different. We are wall to wall surrounded by accessories. A typical dispensary, if you go to Canada or the US, you'll find like 60 to 70 SKUs of accessories. While in Canna Cabana stores, you get up to 700 SKUs of accessories. And this is what makes it that one-stop shop of cannabis, providing an extreme amount of variety to the customer and utilizing that retail space, extracting the best amount of dollars per square foot we can get in our stores. And we keep them tight in Canada. The competition is very severe in Canada. So, you know, we're not building large stores. We're keeping them to 12 to 1,500 square feet. At the bottom of the slide here, you can see in Alberta, we have 58 stores. In Ontario, we currently have 18 stores. We have approximately 10 stores under construction in Ontario. And, you know, unfortunately, over the last month and a half, construction has been on a complete standstill. So that is getting better. And we should be launching another 10 stores or so in just about next 2 months in Ontario alone. Manitoba, we have 8 stores. We're building more stores in Manitoba. Saskatchewan, we have 3 stores. There's more stores coming up in that province as well. Now, this is talking about our e-commerce business. We started with grasscity.com. It used to be our customer, and they only had about, in 2016, they used to buy Valiant Distribution products and sell on their platform. So we had that relationship with Grass City, and this is something to be noted across many of the acquisitions we are doing. We have very deep relationships, you know, Rolodex in the industry since 2009 because we've been a part of the industry. So Grass City is a very unique business. It was founded in 2000. It's the oldest online smoke shop in the world. And High Tide acquired 100% of it in 2018. In 2020 alone, we saw 26 million site visits from cannabis consumers that indulge in accessories. We shipped over 100,000 orders in 2020 alone, and we hold over 560,000 customers in our database. We also have one of the biggest online forums in the cannabis industry worldwide, anywhere, only second after Reddit/Trees. In the lifetime of these cannabis forums where people come and communicate about growing cannabis, about their different interest in cannabis, about their different strains that they like, you know, in the lifetime of that, we've seen upwards of 34 million people. And currently, we have 6.8 million current forum members on grasscity.com. And we also have a very high social media following with 290,000 followers on our social media pages for Grass City. Because of the success of Grass City, we acquired a second company called Smoke Cartel, and we closed this acquisition in March of 2020. And this is one of the most interesting acquisitions we've made. You know, very similar to Grass City, it sells consumption accessories on its platforms, but it uses its proprietary drop shipping technology to do so and carries almost zero inventory. So Grass City offers 6,000 SKUs, 60 to 70% of those SKUs come from High Tide manufactured products. Smoke Cartel offers 15,000 SKUs and carries almost zero inventory and uses its proprietary drop shipping technology to do so, and is very profitable. It's quickly rising, and we're now using this drop shipping technology on Grass City and also CBD City, which I will talk to you guys next. But you know, this is a very unique business where it's asset light or almost no assets except for the platform itself, and we're able to generate some very meaningful results from this platform. This is the next business that I'm very excited about that we acquired in May of 2021. We launched CBDcity.com, which I'll speak on the next slide, which was an organic business that we launched because we already had these very established online capabilities. Because of Grass City, we decided to test the waters in the CBD industry because that is CBD industry is projected to be a $23.5 billion business globally. So, and we had some very successful outcomes from CBD City. Based on that success, we acquired Fab CBD, which is one of the most loved and reviewed CBD brands in the United States. Fab CBD was founded in 2017, and High Tide acquired 80% of that in May of 2021. And we have the option to acquire the remaining 20% at any given time. The founder for the next 3 years, the founder of Fab CBD, Josh Delaney, has joined High Tide, and he's managing not only Fab CBD for us, but because of his relationships in the CBD industry, he's also promoting our CBD business globally and looking at other CBD businesses, which we now are looking to bring into our ecosystem and bring Fab not only to keep on bringing it and establishing the brand in the United States, but also bringing Fab to the Canadian market and sell Fab products in our 87 stores and counting in Canada, and also sell Fab products in EU by bringing the Fab brand through distribution channels in EU that are already established and we are already a part of. And the Fab's acquisition came along being from CBDcity.com, which we launched in May of 2020 as an organic CBD brand. CBD City carries brands from many different CBD manufacturers and established it's sort of like the big CBD mall online. And once we saw the success and the high margins of CBD on this platform, that's what led us to then acquire Fab CBD. And we're very excited to continue to launch even more CBD initiatives and continue to build the Fab CBD brand worldwide. Now, this is talking about our wholesale business here, Valiant Distribution. Our Valiant Distribution is consolidated. Our wholesale business is consolidated under Valiant now, formerly RGR Canada and Famous Brands. So our distribution division extends to Calgary, Las Vegas, and Amsterdam. We have warehouses in all 3 cities. We are contractually tied up with factories in China, the United States, and European Union. I've made over 50 to 60 trips in China over the last 12 years. So we have some very established relationships over there with over 200 factories in China. This is 10 years of experience in designing and branding of consumption accessories. We currently have 5,000 SKUs in our portfolio, out of which we roughly manufacture 75% of them. So we design them, we do the packaging around them, and we import them wholesale and retail through our channels. We also have relationships. We were the first company in 2016 to approach Snoop Dogg to partner up with Snoop on consumption accessories. So we make glass for Snoop. We make vaporizers and other products for Cheech and Chong, Guns N' Roses, Trailer Park Boys. And these are just a few brands that you're looking at. We roughly have about 9 consumption accessory licenses and counting. These licenses are very valuable and they command shelf space in almost any retail settings, not just a cannabis dispensary, but smoke shops, head shops, convenience stores, gas stations. They're sold in many stores worldwide. And we continue to acquire even more licenses as it fits really well in our ecosystem, and given our manufacturing capabilities in China, we feel that we can do more and more of licensed product lines. I know, Andrew, you're on the screen and we want to get into the Q&A, but I think we're almost there. These are just some of the products that you can see that we manufacture. And our future growth drivers, we are known to be the consolidators in the space. The most important elements for us when looking at any companies is looking at the companies that are complementary to our ecosystem and that are immediately accretive to earnings. So having said that, I think we're pretty much at the end of the presentation here. Andrew, I think we're good to proceed with the Q&A.
Raj, wonderful presentation as always. We enjoy having you. To our audience members, just a reminder that you can submit Q&A through the Q&A function on the Zoom webinar. Alternatively, you can also email me directly. Happy to take emails, questions through my email. Raj, I'm going to kick us off with a first question here. The last couple of slides, you're discussing your e-commerce strategy, the wholesale business. These are all very, very strong businesses in the US where you've built those businesses to over a $40 million annualized run rate. And also M&A has been a very important part of that strategy. Could you talk to how you continue to build an M&A pipeline in the US, maybe some examples of the valuations you are seeing out there, and whether you're focused on companies that are complementary and have the same products or services that you already have, or would you look to add new products and new services with your M&A strategy?
Sure. So Andrew, as you know, we have a very robust M&A pipeline presently, and the deal flow continues to get bigger and better. Now that we're on the NASDAQ, even more interested groups are reaching out to us, but we're being very thoughtful and methodical about evaluating these potential targets, looking at them and adding additional e-commerce platforms to further vertically integrate our retail-focused strategy and add even more accessories and hemp-derived CBD segments related business to our ecosystem. EBITDA arbitrage is a very important part of our value creation strategy, so we continue to do that. A lot of these private companies, small companies trade at 6, 7 times, 8 times EBITDA. We trade at completely different multiples as public companies. So we're very focused on doing that, and we have a very robust pipeline. So in the very near future, we will be announcing more acquisitions, as we've declared over the last 4 or 5 months that we're very active in this space, consolidating. We have the Rolodex, we have the relationship, so you should be able to hear more in this regard. But we are definitely working on that EBITDA arbitrage strategy because we have a lot of companies that have approached us, and now the onus is on us to select the best possible candidates to join the High Tide family.
That's great color. Thank you, Raj. Another question here, and this one is on the conference theme, returning to ways that COVID may have impacted your business, including your brick and mortar stores, which I believe you mentioned in your presentation. I think in our earlier discussions, there's also some supply chain issues. What is the upside to High Tide's business as we continue to move past these COVID hurdles that we've experienced in the last 12 months? And how do you expect to benefit and grow as the economy reopens?
Yeah, so we've definitely felt the impact, Andrew, because of COVID over the last month and a half, 2 months. Ontario is on again, off again. So over the last month and a half, we've definitely seen a dip in sales in Ontario, but we saw this exact same pattern over the 2 previous lockdowns. Construction has also been on complete standstill in Ontario, but I'm very hopeful. I'm hearing, Friday we're opening up. So I think we'll see a very good bump in sales back up, exactly how we see in the previous 2 lockdowns. We're also working on more growth coming up in Ontario. Like I mentioned, we have about 10 locations under construction currently in Ontario. So within the next 2 to 3 months, all these stores will come online. Hopefully, we don't have another lockdown type of situation. It doesn't look like that's going to be the case. And you're right, supply chain, logistics, and production in China has also taken a hit. An empty container used to cost us $2,000. Now that's $10,000. But I also think that is short-lived, and production will pick up, supply chain will get better by the end of the year, I think. So things are looking good. There is light at the end of the tunnel. So I think by the end of the year, supply chain will pick up, our wholesale will pick up. Our wholesale has already picked up. As soon as we get any product in the country, we're able to move it, because our products remain to be in very high demand. So I see these hurdles as temporary hurdles, temporary blips, but they're definitely getting better.
That's great. I do have an email question here, and it is on your NASDAQ recent uplisting. Could you spend some time highlighting how the NASDAQ, the recent uplisting to the NASDAQ exchange, what those benefits are, and also how this uplisting could potentially help with your US M&A strategy?
Yeah, absolutely. Look, so I'm very excited about the fact that we became the first publicly traded retailer or a retailer anywhere in the world, cannabis retailer, to start trading on the NASDAQ. And the NASDAQ listing is in line with our keeping our long-term goals for our shareholders by creating increased liquidity and highlighting our company to much larger M&A targets than what we're looking at today. And also opening up to a much broader range of international and institutional investors. As you know, just yesterday we announced that we were added to another ETF, which is the Advisor Shares ETFs. Prior to that, we were added on to THCX, which is another NYSE listed ETF. And prior to that, we were added to HMUS. So that's 3 ETFs that have added us now. We were trading around $300,000 a day 6 months ago. Now we trade around $8 million a day. I think this is going to continue to get better. So we'll have even more liquidity in our stock. And again, we are known to be the consolidators in the space. That is our personality. EBITDA arbitrage is huge to us. So I think with being trading on NASDAQ now, and with all of these groups that are reaching out, and with our Rolodex in the industry, I think there are exciting times ahead in terms of when it comes to consolidating even more in the United States and making some more moves in the US.
That's great. It's just sticking on that theme and, potentially being a consolidator, and also on the theme on recent events. Certainly in recent months, you raised equity capital a couple of times now. You also had a press release out yesterday, potentially noting that you're potentially in the late stages for a bank credit facility. Where do you see your priorities in deploying capital today, and where should we expect High Tide to be active in the months ahead?
So Andrew, building stores, it's not as expensive as what the LPs have to do, put hundreds of millions of dollars in their facilities, but they still cost money. And we put up stores very, very rapidly. Like I said, 10 stores are coming up in Ontario within the next 2 months. There's more stores opening up in Manitoba, in Saskatchewan, in Alberta, and soon to British Columbia. So we do need capital for store growth. So a lot of the funds are earmarked for store growth. And then, we are so active in the M&A space and doing M&A that we want to be ready when the right opportunity presents itself. So obviously we're using our cash very wisely, and we try to use our paper that's very valuable, as efficiently as we can. But in some cases, like the Fab CBD, it was hotly contested, and there were 6 other parties on the table, and the requirement was around $13 million of US cash. And we came up with it. So, the cash is being earmarked for some really accretive M&A that is accretive to our company right away. And also store growth, which we are very rapidly growing. Our goal is to get to approximately 115 stores by the end of the year. Now, construction has slowed us down a little bit. And we may be, 5-10 stores off from that number, or we may still hit it. So, but we definitely need to have some stores. So that's sort of where the use of proceeds will go.
That's great. And maybe if we can sneak in one last question here. High Tide operates as the leading pure play accessory e-commerce platform in the world, Grass City and Smoke Cartel, and you continue to build on that. Could you speak to where the business is today relative to the total addressable market opportunity, to give us that final blue sky upside scenario as to how big this opportunity could be down the road?
Yeah, absolutely. So as per Q1 of 2021, I think our approximate spread of cannabis versus accessories was 70-30. So we're talking about roughly about $50-60 million. So this is rough math on accessories. The accessory industry in US right now is sitting at around $1 billion. So we're just at 5% of that total space. Even CBD, right now we're doing between $13 to $15 million on hemp-derived CBD products. But that is projected to grow to $23.5 billion in the next 5 years. So there's a lot of opportunity in the accessory space and the hemp-derived CBD space. And we are just in our infancy of growth when it comes to both accessories and hemp-derived CBD. So there's a massive opportunity that awaits us. So this is sort of the closing thoughts that I'd like to leave everybody with, is not only are we a leader in bricks and mortar retail in Canada, and we're very well rehearsed for what's coming up in the US, we also are sitting at a massive opportunity for accessories and CBD, and this has already been part of our DNA and personality since 2009. So, we're in a perfect position to capitalize on both accessories and CBD business.
Raj, on behalf of all of us here, I'd like to extend a big thank you for an amazing and engaging presentation. We thank you for joining us. We look forward to watching and participating in your future success. As a reminder to our audience, High Tide trades on the TSX Venture Exchange and the NASDAQ Exchange under the ticker symbol HITI, and we rate the share speculative buy with a $20 per share Canadian price target. We've got a full high quality lineup of more amazing presenters today. We're going to pause for just a few seconds as we queue up our next speaker. My colleague Stefan, Director of Healthcare Research, will be on screen in just a moment. to introduce our next presenter. Thank you, Raj, and thank you, everyone.
Well, good afternoon, everybody. It's my distinct pleasure to welcome David Wolf, the CEO of Hamilton Thorne, to our conference today. In my humble opinion, Hamilton Thorne is one of the highest quality small cap Canadian listed healthcare companies. As I'm sure David will highlight in his presentation, the company has a strong competitive position in the very attractive and growing assisted reproductive technologies market. Under his leadership, the company has a track record of growing faster than its end markets, as well as making strategic and accretive acquisitions. So with that, I'm going to hand it over to David to tell you about how he's been managing through the challenges of COVID and where the company is heading in the future.
I will let you know this presentation is on our website, which is www.hamiltonthorne.ltd. So for people who want to see the full presentation, and as I certainly skip some slides, be able to do so. Next slide, please. And next as well. So as Stefan mentioned, what we do is design, develop, manufacture, and market a wide array of products that are used in the assisted reproductive technologies field. We are US headquartered, but truly have a worldwide business. We are well positioned as a premium supplier of products in our field. We've grown, as Stefan mentioned, pretty substantially, about 35% CAGR over the past 5 years, through a combination of above market organic growth as well as acquisitions. We've completed 6 accretive acquisitions over the past 6 years, roughly on a pace of 1 per year. We see potential for accelerating that, but certainly we're not essentially a roll up where you might see an acquisition each month or each quarter. Just to give you a snapshot of our performance, we did just under $41 million of revenue during the 12 months ended March 31. I should mention that we report in US dollars. We are profitable with positive cash flow, very CapEx light business. So we generate a fair amount of free cash conversion, did 7.1 million of positive EBITDA in that same 12-month period. And we have a strong balance sheet. We have about $20 million in cash in the bank, plus a line of credit, which is used to fund our acquisition activities. Next. Thank you. So I'll spend a moment describing what is assisted reproduction. It is the range of technologies and services that can improve the rate of successful pregnancy. As I mentioned, we tend to focus on the IVF clinic and even more specifically on the laboratory of the IVF clinic. So just to be very clear, we are not providing patient-facing services. We're not doctors or clinicians. We provide the tools, the precision instruments and other capital equipment, consumables, and supporting services that are used by the laboratories of the clinics to deliver the results that they're looking for. To give you a sense of the overall size of our field, there are about 2.4 million assisted reproductive procedures performed annually. Next slide. And that translates into roughly $20 billion of spending at the provider level. So that, again, is what's spent on the physicians, the pharmaceuticals, a lot of areas that we don't participate. What we do is offer products, again, that are used in the laboratory, which is about a $1.2 billion addressable market. An interesting attribute of our field is that it is highly fragmented, both at the clinic level, where I won't spend a lot of time today talking about because that's not our business, but it's our customers, where there is consolidation going on. It's a little bit more or less in some particular countries, but on a worldwide basis, even the largest clinic chain is less than 2% of the overall clinics. Our side of the world, which is the supplier side, is also highly fragmented, a little less so as you imagine. But we track well over 200 companies that have participated in some way. Some are pure startups, some are very large in this field. And as part of our acquisition strategy, have identified over 160 that could be potential acquisitions for us. Now, some of them are a little bit larger. A couple large players are over $100 million of revenue. There's a mid-sized tier that are in our size, and we're sort of emerging from that tier to become one of the challengers, if not the challenger to the 2 larger players. And then a long tail of well over 150 companies that would be the kinds of companies that we would typically look to acquire. Not so much that we're unwilling to do one of these larger deals, but there's just so many more of those available. Next slide. So what is driving the growth of IVF? There are two dramatic demographic trends. One is that women are waiting longer to have children. And it's very clear that while fertility can stay pretty strong and stable during 20s and early 30s, it drops precipitously in the mid to late 30s. And as we've all observed with friends, family, or colleagues, that the need for assisted reproduction is there. The other dramatic demographic driver is that this trend that I've discussed is very well known and pronounced in Europe, which is, I'll show you another slide, perhaps the leader in IVF, certainly in North America. But I like to think of developing countries where they're beginning, particularly in those that are rapidly building rapid middle class. So I think of India as an example, where in the cities, the emerging middle class and professional class are beginning to behave like North Americans and spending their 20s and 30s establishing their careers, their families, get education, getting independent. And then when they want to have children in their 30s, they have the same physiological issues as everybody else. So India, again, is a fast-growing country for us, fast-growing market, but still on a per capita basis, very, very small. So enormous opportunity for growth. And of course, that middle class can afford to pay for IVF. Next slide. I won't spend a lot of time on the next two slides in the interest of time, but this is really to emphasize where we fit in our world. We are supporting the procedures that are used in the laboratory. Next slide, with a wide array of products, capital equipment, including some very unique and high technology systems like laser systems, imaging systems, consumables, the classic reagents and disposables that are used on a daily basis in connection with every procedure, and then the services to support both the capital equipment that we sell as well as services to support particularly the quality of products in the laboratory. Next slide. Again, this is something you might want to look at on your own, but I think, if you look at our business, we are about 85%, almost 90% of our business is in the human clinical market, again, supporting IVF clinics, though important parts of our business are selling products for the animal breeding and research markets. They tie all very nicely together and continue as we think about what comes next, our future growth. From a product mix perspective, a little less than half our business is capital equipment, and the balance is a mix of consumables and services. The capital equipment business is a tremendous business, very high average order size, great margins, but can have some lumpiness to it. So we've actually worked hard to offset that with a growing consumables and services business that has much more of a repeat and certainly in some cases contractually obligated recurring revenue component to it. So we think a nice portfolio mix of products. And similarly, from a geographic perspective, we've got a portfolio mix as well. Our largest, this sometimes surprises people, our largest geographic region that we support is Europe. But if you think back historically, IVF got its start in Europe. Some of the trends that I discussed in terms of age of for pregnancy for women is certainly more pronounced in Europe. And there's much more social support for IVF in Europe in terms of insurance and state-sponsored support. So the per capita usage of IVF is much higher. US, which is about 20, in this case, 23% of our market, and Asia Pacific is the balance. We certainly expect to see greater growth in the Asia Pacific region and the US and other parts of the Americas over time. So I'm not sure that chart will ever quite get to 30, third, a third, and a third, but we would expect to see that even out a little bit over time. Next slide. We go to market through a combination of direct and indirect channels. We have major operations in the US, Germany, and the UK, manufacturing and distribution operations. We also have direct sales in France, which we've just launched, a small outpost in Singapore, and we just completed an acquisition in Australia, which gives us additional coverage. We support the rest of the world through typically highly specialized distribution partners who are typically from the IVF field, know a lot about it, are able to be much more value-added resellers than pure, I would say, classic catalog-based distributors. I would expect over time that you would see more and more of those red pins turn to blue pins. By no means will we ever have 100% direct sales. Some markets are just too small. Other markets, frankly, we have great distribution partners. There's no need to displace them. But over a longer period of time, I think you will clearly see more and more markets where we have our own people. In terms of why our customers buy from us, I think it's really what our brand stands for. We have premium products. We obviously need to be price competitive from time to time, but we are not by any stretch a price leader. And we justify the pricing of our products by the reinvestment that we make back into the business. We spend around 6 or 7% of our gross sales, which is almost 25% of our profit back into R&D. And then we have a tremendous commitment to service excellence, the kinds of things that really lead to greater customer satisfaction. So that's a little bit about the products and the business and the markets. I'll segue a little bit to our longer term growth strategy, which I mentioned briefly has been through a combination of organic growth. Our field is growing about 7%. We've been growing well over 10%. I'll talk about, except for one quarter last year, where certainly we were impacted by COVID. But we augment that by a very active acquisition program. The purpose of our acquisition program is pretty clear. It's to accelerate the scope and scale of our business. The larger we are, the more important we are to our customers, the opportunity for operating leverage. We become, in some cases, it could lead to survivability because we have greater capabilities. We've also want to expand and have significantly expanded our product portfolio. So today, we're not quite a complete one-stop shop for the lab, but we can provide nearly everything that a lab needs. And through a combination of both our own product development and continued acquisition, we would expect to get to the point where we can provide most, if not all, of the high-value specialized products that are used in the IVF lab. We'll leave the commodity products to somebody else, but for those high-value specialized products, that's important for us. One thing that I think really separates our acquisition strategy from a number of other companies is the level of discipline and resources that we put to it. We have not a huge staff, but a dedicated staff working on acquisitions. We look at all of the acquisitions. We know the potential. It's not a huge universe. I mentioned about 160 companies. We've stack ranked them based on desirability and through a number of filters. And we make sure that we have active discussions going with nearly all of them at any time. Here's a list of some of the, or I guess the tombstones of some of the deals that we've done. Again, the presentation is on our website if you want to look at the details. But I think the two takeaways are we've tried to be very responsible in both sources and uses in terms of what we paid for these businesses. We're typically paying for these more established businesses between 5 and 7.5 times EBITDA. And for some of the smaller business, it's often a little bit on a multiple of revenue, and there we've been kind of 1, 1.5, and maybe nudging 2 times. So we're again very responsible about how we pay for these. And then on the sources side, we certainly understand that if it's great to be a public company and it's great to have access to the market, but it's not great for shareholders if every time we do a deal, we go out and raise money in the market and create additional shares. So we're very clear and careful about how we think about our weighted average cost of capital, use our own cash, which we generate from operations, bank debt, which is available to us, seller participation, whether it's a debt or equity, and then of course we have used the capital markets from time to time when we need equity. Here's a view of our last 12 months. I think, as I mentioned, we did have a pretty significant COVID impact. If you look at Q2 of last year, we saw our sales shrink for the first time in certainly my memory of the business. But certainly over Q3, Q4, and into Q1, we saw a rebound. I know one of the themes of this conference is how COVID both has affected us and what the resurgence can look like. So clearly, as a worldwide business, with a lot of our business in Europe and Asia, we're not running at 100% in all markets. In the US, well, the Americas, we do announce the number and don't break it out specifically for the US. Just to give you a sense of Q1 of this year was up over 30% versus Q1 of last year, where our overall business, while it was up over 10%, was a little bit less. Again, you can view this in the presentation. I'll finish up with a little bit of a summary of our capital structure. We have just around 140 million shares outstanding. We have a very clean cap table. We do have stock options and RSUs that have been granted to our loyal employees and officers and directors, but we don't have, and by the way, these are fine things to have, but they do make the cap table more complicated. We don't have warrants. We don't have convertible securities. So we've got a very clean cap table, only common stock and common stock options. And then on the balance sheet side, we have, as I mentioned, over $21 million of cash and relatively modest debt, about $7 million of debt, all of which is bank debt, some of which was government supported, so zero or very low interest, and even the balance, which is bank debt, ranges from around US prime to at a max for some of our term debt to 4.5%. On the shareholder side, we've got a nice mix of shareholder ownership. About 25% is owned by management and directors. So again, I think strong aligned interest with shareholders. 25% is classic float, and about 50% is institutional ownership, a combination of US and Canadian, and some actually becoming a growing amount of European institutional ownership. Our share price has been growing. We've actually been on a great run this year. So we were, I guess, a low for the last 12 months of $1.10 and a high of over $2. We're trading about $2 right now, which gives us a market cap of about 270-ish US Canadian, about 220 US. Our goals for the balance of this year, actually very similar to our goals for last year. We want to continue our strong profitability and positive cash flow and continued growth. We are focused on accelerating organic growth. We are making investments in increasing our direct sales teams, launching new products, adding new territories. We obviously want to increase awareness in the capital markets, both to increase liquidity and bring in new shareholders, hence the reason we are delighted to have been invited to do this presentation. And of course, the continued and disciplined execution of our acquisition strategy. So I thank you very much. I think I brought this in just around 20 minutes, which might be a world record for me. And I'm happy to answer any questions that I can.
That was amazing, David. If you exclude the 5-second little issue at the beginning, you hit exactly 20 minutes, like to the second. So good job there. Thank you for doing that and sticking tightly to the time limit. I just want to remind everyone you can ask questions through the Q&A function, and we already have one in the Q&A function, and I've received a couple of emails. So the first question is, who are the other 8 supplier companies that you mentioned, and maybe talk a bit about, in a little more detail about maybe the 2 bigger ones and the other ones that are more sort of your more immediate competitors from that perspective.
Sure. So I think that's a great question. I'm trying to toggle back to that slide. I gave up control. So if whoever's in control could put me back on slide 5, that'd be terrific. So the way our competitive universe lays out, as I mentioned, there are well over 150 companies that are in our field. To some level, we compete with every single one of them on, in a given geography and a given product line on a given opportunity. But clearly, you see more of the larger players. The 2 larger companies are interesting in their own way. Vitrolife, which is publicly traded, symbols VITR, is as best we can tell, is the largest player in our field. I think they did about $130 million on a trailing 12 months basis. So, again, bigger than us, but by no means a dominant player in the market, have an enormous valuation. Some of it, I think, is, well-deserved, larger business. They've got a, greater scale, so greater EBITDA margins. But I think they're also, I'm not sure we'll ever get exactly to that valuation metrics, but they're a, good example of what we might be able to look like at a larger scale. The other large company is a little bit harder to determine exactly what they're doing. It's the Cooper companies, Cooper Surgical Division. They do break out some numbers in their public reporting, but it's, thank you, but it's not as robust reporting, so we don't know anything really about exactly, because they also include some parts of the business that we wouldn't consider part of our addressable market. So it's not exactly apples to apples. Of the mid-sized players, a few of those I would say are, well, the 8 includes us, so, but a few of the 7 balance, a few of those are more horizontal players. So I wouldn't see us, they're important in our market. We either compete or collaborate with them. So I'm thinking of companies like microscope companies like Olympus and Nikon, where they provide tremendous amount of product that is used in the IVF lab. Nearly everything we're talking about is, microscopic in size, tiny in size, measured in nanometers. You need to take a look at it under a microscope. But we're not going to buy Nikon, and they're not going to sell off their IVF divisions. It's really essentially the same microscope they sell into other products. The balance of them are companies you probably would never have heard of, but they're big in our field. Japanese company called Kitazato, a Singapore company called Esco, US company Cook Medical. It's actually a very, very big company, but it's a small part of it, privately held. And then again, there's 100 and we do talk to all of them at some level and have a business relationship with many of them. In some cases, they're our customers. In some cases, we're customers of theirs. In some cases, we collaborate with them because customers want a complete solution. But again, when I think of our typical acquisition program, most of the companies we've bought, or I guess everything we've bought up to now, have been 20 million of revenue or less, and there being so many more targets of opportunity there, I think it's more likely that that's where we would participate in the future.
Great. So just while you're sort of finishing off on M&A, question came in by email. You talked about the type of companies you look at, but you didn't really talk about sort of, do you have a geographic focus as you talked about your balance of where your revenue is coming from. Are you looking to expand in markets where you feel you're a bit maybe underpenetrated, like Asia? You recently did a small acquisition in Australia. It was quite small. Is there a shift in your focus to those geographies?
Yeah, so from an M&A, that's a great question. From an M&A perspective, and I think in almost everything we've done, we've been pretty methodical about this. So our first acquisition was essentially a product line acquisition we bought from a division of Perkin-Elmer. I think they were 20 minutes down the road from us. So, a local business, company we knew, we had sold that product, we had just a great deal, a high level of confidence that we could complete that acquisition properly. Next acquisition, another US-based business, a little further away, but nevertheless one that, it's not that we were completely cautious about it, but if you needed to, you could go drive to it and solve problems. As we've expanded our business and expanded our scope, we've done a couple of acquisitions in Europe. And as you mentioned, we most recently bought a business in Australia. So in terms of geographic, I would say if you asked me the question 3 years ago, I would have said we're pretty focused on US and Western Europe. Right now, I think we've got to a scale, and the market has evolved as well, but got to a scale where we have a worldwide focus.
Great. So we've got a couple more questions that just bounced in on the Q&A. So I'm gonna jam them into one question. One is, how many deals do you expect to do per year, and what sizes are you contemplating? And then the next question, which follows logically, what level of debt to EBITDA are you comfortable with as you contemplate more deals? So I've turned two into one.
Yeah, so I think I can answer those pretty consistently. So as I said, given the nature of our target universe of potential acquirees, it's more likely that we'll be doing deals on the smaller end, maybe ones with $5 to $10 million, maybe a little more, maybe a little less of both, I guess, of purchase price, and then revenues will be a little bit less than that. In terms of our capability to finance those, we have, as I mentioned, over $20 million of cash on hand. We do have a dedicated acquisition line of credit, as well as a very supportive bank. From a covenant perspective, we're limited to up to 2.5 times EBITDA. We're very comfortable at 2.5 times EBITDA. I would say we're comfortable higher than that if we were looking at a short-term situation. So I could imagine, for example, we find a company that's got tremendous cash flow, not CapEx, not a lot of CapEx coming down the pipe. Perhaps we'd go up to 3.5 or a little bit higher in terms of leverage, but we would want to have a pathway to see how we could get back to a much more comfortable for us leverage ratio. So what that implies, if we end up doing more than a couple of acquisitions within a relatively short period of time, if they're on the small end, we can do that with available resources. If they're on the larger end, we might look at having to access the capital markets, because we look at everything as in a holistic fashion, weighted average cost of capital, as well as our comfort around cash flow and leverage.
Great.
I think I hit all 4 parts of your 3-part question.
You're doing great, and you're keeping it tight too. I like it. I have another question here. I've heard about private equity rolling up IVF clinics in the US. What does this mean for your business? And is this having any impact on your operations? It's a very good question.
Great question. So IVF, private equity is rolling up, and as well as some clinics that are looking to expand through their own efforts, are rolling up clinics on a worldwide basis. So there are active IVF roll-ups in the US. In Canada, there's actually a pretty active IVF roll-up. UK, parts of Europe, Australia is almost completely rolled up. So, again, in certain markets, we see a significant concentration. Thus far, one of the things you would worry about, of course, is that changes a little bit of pricing power and dynamics, which, so thus far it hasn't really been a factor. There's been some, obviously, larger companies want to get good deals and sometimes better deals. The other side of that, though, I think it actually plays to our advantage, is one of the flip sides of trying to get better bargaining power is reducing your number of vendors. And we're one of a really small handful of vendors that can provide, in the markets where we sell direct, certainly everything that is used, or virtually everything that is used in the clinic. So if a roll-up is trying to look at, improve strategic sourcing, typically it's not just beating vendors up for price, it's convincing vendors that will source more from you, therefore it'll be lower cost for you, and we'll end up, both of us, having some kind of benefit out of that. And if you look at that list of 160 companies, even some of the larger companies really have fairly narrow product lines. So there's really only a handful of that 160 can play in that game right now.
Wonderful. So we've bumped up against time. So that's been great. Thank you for your time today, David. Great presentation. I want to remind everybody that Hamilton Thorne trades on a TSX Venture with ticker HTL. We buy rated with a 225 target price, $2.25. So thanks again for your time today, David. So with that,
my pleasure. Thank you very much.
Yeah, we're going to pause for a few seconds and queue up the next speaker. I'm going to hand off to my colleague, David Crystals, our real estate analyst, who will be on screen in just a few moments to introduce our next presenter. And thanks again, everybody, and thanks again, David.
Thanks, Stefan, and thanks again, David. Moving into real estate, today we have with management of BSR, an owner and operator of multifamily apartment properties in the U.S. Sunbelt. The ticker is HOM.U on the TSX. Since their 2018 IPO, the REIT has completed a transformational capital recycling program, including approximately $900 million of acquisitions and $600 million of dispositions, and currently on a portfolio in excess of $1 billion, concentrated in markets with some of the lowest employment rates, highest employment growth, and highest population growth in the U.S. We're particularly happy to have them with us today in advance of the presentation later today at the 2021 REIT Conference, where they'll be sharing their story with more than 3,000 investors, executives, and professionals. So with that, I'll turn it over to John, Susie, and Ben. Thank you, guys.
David, thank you for Echelon for having BSR REIT and giving us a chance today to tell a little bit about our story and why we're so excited for our company and our prospects going forward. I'd like to introduce or allow our team to introduce ourselves quickly. If Susie, if you would, and then Dan, and then I will, with a little bit of color on the history of the company and where we are and where we got to today. Susie, you want to start with the introduction?
Sure, absolutely. Again, my name is Susie Kane. I am the Chief Financial Officer of BSR REIT. I joined BSR in December of 2013. Previous to that, I worked for EDR, which is a collegiate house that was traded on the New York Stock Exchange. And I began my career at PricewaterhouseCoopers. So I've been at BSR for about 7.5 years now. And we've had a lot of activity that goes with the first paying off our private equity to the spinoff of our affordable housing up to our listing on the TSX, and then turning around and recycling 75% of our portfolio, which we will tell you all about today. And with that, I will hand it over to Dan to introduce himself.
Hello, everyone. I'm Dan Oberste. I'm president of the company. I come from a legal and acquisition background, both within the company and its predecessors. Recently, and I think that some of you may know that we executed what I would say a pretty efficient capital recycling plan in the last 3 years, whereby we sold around 38 properties and bought around 18. And prior to that, we became public on the exchange in 19, off the backs of really conducting a rather substantial capital redevelopment plan consisting of roughly $50 to $60 million of capital investment in our portfolio and suite upgrades and property upgrades. So those departments of acquisitions, dispositions, asset management, market surveillance, that's where my background comes from.
Thank you, Dan. And my name is John Bailey, and I am CEO of BSR REIT and have been for the last 30 years. I'll say I got into this business rather honestly. Both my mother and dad, my late mother and dad, started this company back in 1956. And it wasn't until 1991, after I had been trading as a floor trader at the Chicago Mercantile Exchange, trading Eurodollar futures, that my mother was retiring from this business. And it was a perfect time to take my family, move back to Little Rock, and begin investing in primarily apartments. Over the years, I guess from 1991 until the end of year 2012, we had accumulated 4,400 apartment suites. And that was at the time that we merged in with another company out of Montgomery, Alabama, Summit Housing Partners, and my partner, Daniel Hughes. And at that point in time, we had a total of 8,400 suites, market rate suites. And as Susie alluded to, there was an affordable portfolio that had come in and bolted on alongside with Daniel Hughes's market rate suites. And what we did is we sold and monetized a good bit of that portfolio and bifurcated that piece of the company. And we monetized about $32 million. And what we did with that money is that we were going to take that back and do value add projects into the interiors of our suites, doing upgrades, as well as improving the amenities that we were offering on our properties, with the objective to increase rents and occupancy. And just as a testimony to what happened by the year end 2015, all the way going into the second quarter of 2019, the NOI of the properties that we owned of the same store increased by 30%. It was quite a very successful venture. When we went public on the TSX in 2018, we were in the midst of completing and undertaking the program of value add projects. And BSR became known somewhat as a value add player of multifamily B-class assets in the mid part of the mid-central region of the United States. We're located in 3 different states right now in the United States, which is in the Sun Belt, but that's Texas, Arkansas. And if you wouldn't mind going to slide 5 with me, please, David, so that we could So you can see that it's Texas, Arkansas, and Oklahoma. And we own and manage about 7,660 suites. You know, in the beginning, when we went public in 2018, we had 14 different markets that we were in. Today, we're in 5 suburban areas of the primary and secondary markets of Austin, Houston, Dallas-Fort Worth, Oklahoma City, and Little Rock, Arkansas. All of the rest of the cities and locations that we had told the market we were going to sell and continue executing a rotation strategy. As what we saw shortly after we went public, about 6 months after we went public, was that we had a tremendous compression of cap rates. So the values went up tremendously in the secondary markets compared to the primary markets at a level that I haven't seen in my lifetime. And so we took advantage of that for our shareholders and actually sold all of these assets that Dan had alluded to before in taking this transformation of this company and extracting an extra 10% more than what we had put those assets into the REIT for. And we rotated that capital and put it to the primary markets of Dallas, Houston, and Austin. So this is why we're just in 5 markets. And why did we go there? We did it with a discernful strategy of understanding that this is where the highest growth has been predicted over the next 5 years. And I'll tell you from my lifetime in the Texas markets, they consistently grown faster than the national average. And we've seen over this past year a tremendous amount of growth that has happened with not only people moving out of these large states and northern states that have had shutdowns, but they've come down because of the business environment being so open and the regulations being so, I'll say, available for businesses to operate. So we do have a tremendous amount of runway. We've been seeing some tremendous traction in our rental growth. As for an example, right now, as if you want to talk about the month of May, on all of our new leases, we've been experiencing 8% rental growth. And for I'll just say on the renewals of our leases, it's been at 3% for a combined average of close to 6%, which is very phenomenal. We've seen this continue to step up, as April was a little bit below that on the combination. So we didn't think that this traction would take hold of coming out of this pandemic until the second half of the year. But what we're seeing is Texas and these markets being open, that we're seeing a tremendous amount of business activity, rental growth, and I would say overall income growth for all of our middle income cohort. So please turn with me to page 6. Just to give you a little bit of context about what our garden style assets look like. They are very low density rental communities. They're typically situated maybe on 20 acres of land, maybe having 15, 20 buildings. And they're typically 2 to 3 stories high with maybe up to 16 units in each one of the buildings. And so there is a very much of a higher lifestyle of a resident that could take advantage of all the amenities that we might have either put on the site or we may have purchased the property with them. For instance, dog parks. And if you want to talk about grilling stations, the swimming pools, even some running trails that have been on some of our assets. And of course, the fitness centers are pretty much of the lifestyle that our residents, the younger type of cohort that are living on our properties, which are middle income cohort resident, making about average of $60,000 US per year, have really taken advantage of the very affordable apartment communities that we own. If you wouldn't mind turn the page to page 7. Just from a standpoint of the investment highlights, Daniel Hughes and myself, we own close to 40% of the total shares of the company, most of it being in OP units. So it's not in the float, but in terms of our markets, they're extremely highly favorable fundamentals, not just from a standpoint of the economic growth that we talked about, but we're also seeing it from a standpoint of renter migration coming in from all over the states that are along the coast. Tremendous amount of population growth, and it's wonderful. They've done a study, and the population growth that's coming in is the profile that one would want. You've got 50% they've noted as being having 4 years of a college education. If you look at our portfolio, we do have embedded growth opportunities, and we have certainly executed on a very proven growth strategy. As we have, what Dan had mentioned is we have bought over $880 million of property over the last 2 years after selling about $550 million of assets. And right now we have about $250 million of dry powder that we have available so to purchase. Please turn with me to slide 9. And of course, we are an internalized management platform. We came into the REIT that way, and no one's paying anything for this platform. We do look to fully exploit this opportunity as we go forward and looking for opportunities for the REIT to continue to grow. But with that being said, not only were we founded in 1956, but we are rated as one of the best places to work in the state of Arkansas for 4 years running, which speaks volumes to the type of company that we are. We have an excellent online reputational assessment scoring. And what that really means is that residents score the property owners of REITs in the United States, and BSR has been in the top 5 of the ORA scoring ever since we've been listed at the TSX, which we're very proud of. We've been as high as 2 and as low as 5, but we're right in the middle right now. And we continue to try to work that score and having our residents be very satisfied. We do have a very low employee turnover, which also speaks volumes again about the training that we do for our employees, as it's about 50% of the national average. If you would please turn with me to slide 11. Just to give you some context, we believe that we are in one of the most top performing sectors of real estate. As for the last 20 years, from 1999 to 2019, the multifamily sector was the highest performing sector, outperforming the next one, which is industrial, by 12.4% to 10.4% on an annualized basis, and that includes dividends. Please turn with me to slide 12. And this may give you a little bit a better context of just where we're situated. We're situated in the Sun Belt region, but in the mid-Sun Belt region of the United States. And this slide depicts that the Sun Belt has been consistently outperforming the rest of the coastal and the national markets in general, as the Sun Belt has achieved a 15% annualized return, as opposed to the coastal markets at 3% and the national average at 10%. And please turn to slide 13. A little bit over half of all the BSR cohort, who are middle income residents, they are of the millennial class. And the millennials, their ages of between 21 and 34 years old. They like the flexibility. They love the lifestyle. As I was talking about, the amenities that we offer in our properties, to enjoy those amenities. And, you know, when you think about this particular cohort, this group, they do have a more of a propensity to rent because of the high debt profile that they have. They have taken on so much debt for their education debt, going from about half a trillion dollars back in the early part of the 2000s to about 1.5 trillion today. And so Dan's going to talk a little bit more about our quality portfolio and the embedded growth opportunity. So Dan, would you please go?
Sure, thanks, John. I'm looking at page 15, and for everyone who's following along. This is going to identify we're just going to talk about some of the key ingredients to what BSR looks at in our markets. The key ingredients of apartment investment are going to be population growth, personal income, and total employment. So when we think about population growth first, we look at population growth in our markets, and it's triple the pace of the national average. It's well in excess of the gateway markets in the last, let's say, dozen or decade or so. And let's highlight one market in particular that we're invested in, and that's Austin, Texas, where we've seen population increases in excess of 29% since 2010. Now that's 6.5% higher than the second fastest growing city in the nation, which would be Raleigh, North Carolina. The other two of our other two Texas markets, Houston and Dallas, are in the top 5 to top 3 year over year in population growth and also in job growth. Now, when we look at personal income, what we're, and for everyone following along, I'm looking at page 18 of the deck. What we want to highlight here is it's not the money you make, it's what you do with it. In our markets, if is depicted on slide 18, the resident spends on average about 20% of their personal take-home income on rent. You compare that to the gateway markets where they spend about 40%, or the national average of 27.2%. So when we look at what our customer profile spends their money on, we see a whole lot of upside in markets that are extremely popular. And by popular, again, I'll highlight Austin, Texas, which again this year for the 4th year in a row has been named by US News and World Report as the most desirable or the best place to live in the United States. So in that respect, we want to talk about a little bit about what we own in these markets. And I'm looking at, call it slide 19. What we're going to acquire in these markets is generally going to be a newly constructed asset or a recently constructed asset. These are located on large swaths of land. Oftentimes they look like large mansions or what we refer to in the United States as garden style or mansion development. The majority of our residents have covered parking or garages. There are amenities throughout our properties that include 2-story workout facilities, dog parks, multiple swimming pools for each property. I think we still might have a couple of fishing lakes attached to the back of some of our assets as well. The average rent for our assets is around $1,100 to $1,200 a month. And the majority of them are located, I'm looking at slide 20, the majority of them are located in Texas. So our 3 core markets are going to be Austin, Dallas, and Houston. Those are our 3 Texas markets. Our 4th market, Oklahoma City, it's not as, I would say it's not as much of a household name as Austin and Dallas or Houston would be, but I can tell you it's a perfect example. Richard Florida, a reputable author, wrote a book about Oklahoma City. It's called The Next American City, where he talks about how what Oklahoma City did in transforming itself in the early 2000s by financing infrastructure growth and better schools through sales tax was forward thinking as opposed to real estate tax increases. The second thing they did in the early 2000s was they brought the Oklahoma City Thunder, a professional sports franchise, to the market. What we're seeing and what we have seen for the past 15 years in OKC is just massive asset accretion. We've seen above average population growth, job creation, and a nice hub for what we would refer to as a North Dallas market of around 1.5 million people in Oklahoma City. With that, moving on to slide 21, when we look at the average market rent per square foot in our primary markets, you can see that from 14 to 19, you have compound annual growth rates of ranging between 1.7 and 4%, Dallas, Fort Worth being the highest. One thing I want to highlight here is that each of our markets today, this quarter, are sitting in historic peak effective rent growth. So to say that again, each of our 4 markets in the second quarter of 21 have rent increases higher than they have than their entire history. And if I wanted to call out one in particular, I would say Austin is currently experiencing a projected 18.8% market rent growth through year-end 2022, according to RealPage and CBRE. This is a multifamily market in the United States in the Sun Belt that is absolutely on fire, not physically. It's not hot. It's not hot down here yet, but metaphorically, we are absolutely just we can't buy enough properties. We can't lease them fast enough at high enough rates. We're really happy and proud at what we did. Now, if I'm looking at slide 24 before I hand it over to Susie to discuss the balance sheet, these 17 properties are indicative of assets that we've acquired since our IPO in 2019. As I said, most all of them are newer construction. And are located in our 3 core Texas markets. And as John highlighted, and is highlighted on slide 25, since the IPO, we've acquired roughly $882 million of assets balanced against about $620 million of dispositions. So with that, I'll direct everyone's attention to slide 28. And Susie, would you like to provide the financial review?
Absolutely. Thank you, Dan. And I'll go quickly so we can have some time for questions. I think the key here for Q1 to note is we have revenue growth and same community revenue growth and same community NOI growth that outperformed our Sunbelt peers. This is impressive because, as we mentioned earlier, we've sold 75% of our portfolio while at the same time continue to have top performance with the communities that remain in the portfolio. What I do want to point out is you'll see the decline in FFO and AFFO. Nobody panic. All this is a result of timing. We've sold more assets basically than we bought. So we sold 12 assets in the fourth quarter of 2020 and didn't purchase again until the last day of the month at Q1. Hence the absence of NOI for the assets sold versus when we purchased again, starting at the end of Q1 and then again in Q2. The payout ratio is the same issue. That will go back to a more normalized 80-ish% once we finish our recycling program, which has to do with spending our dry powder, which I'll talk about in a second. Fourth quarter, looking at the year, it's pretty much the same story. Revenue for same community basis is up, NOI is up as well, and FFO and AFFO are slightly down due to the timing of when we purchased versus when we bought. Moving on to slide 30, here you'll see our debt to GBV is 44.3%. We're comfortable going up to 55% if we have the right opportunity. Our weighted average term to maturity is 7 years. And of course, our weighted average interest rate right now is 3.6%. Key here, though, is we have total acquisition capacity of $287 million, of which we expect to spend a good portion of before the end of the year. Another thing I'd like to point out right now is that BSR continues to trade at a discount to NAV. And our NAV continues to go up. So we announced at the end of Q1 that our NAV was up 8.6%, I think, over the prior year. We expect our NAV to continue to go up throughout the year because of the impressive growth we're seeing in our markets. Our NOI keeps going up based on what Dan has just told you. And yet we're still trading at a discount, and our US peers that are in the Sun Belt trade at premiums. Our Canadian multifamily peers are certainly trading right at NAV. So we look to be the only REIT on sale right now, and we're located in some of the best growth markets in the US. So I think this is a very compelling story if you're looking for a deal right now, to definitely take a look at BSR. Thanks. And with that, why don't we turn it back to David for some questions?
Great. Thanks, John, Susie, and Dan. So we will rush through questions a little bit, but I do want to touch just on your last point because the first question may relate to that. Given that the U.S. peers are all trading at premiums to NAV, we have a question asking: are you planning a U.S. listing, or is there a U.S. listing planned at any point in your future? What would it take to get there?
David, this is John, and no, not in the near term. We really would like to, we know that why we went public in Canada was the great support we've had both on the buy and sell side. We've seen from all the case studies of even Milestone that had gone public back in 2012. They went private in 2017 after having done 9 follow-ons, and they went public at $10 a share Canadian and went private around $22, a little bit north of that when they went private. And we sense that it's taken a little bit of time for our Canadian investor to understand BSR and our story. But we do believe that that we are getting more traction and understanding with what's been going on as we're doing this with you today. And we really do appreciate you having us on to be able to tell our story. But it really does cost a tremendous amount of additional dollars to go have a dual listing. And for our small size, it really doesn't make sense. We made the decision to go public on the TSX for that reason.
And along the same vein of the kind of differences in the Canadian operating environment and the US, and given the theme of our conference is the post-COVID economic recovery and rise in inflation at the US, can you maybe speak to your ability to very rapidly pass on any inflationary growth in rents as opposed to being hindered by rent control?
You know, first of all, I'll say that we have had, definitely some costs that have been embedded into new construction, and it has made the dynamic of there being a lesser amount of new product that is being forecast for being built for obvious reasons. But you had a tremendous amount of demand. Our teams have told us that they've never seen more traffic than what we're seeing today. We have our occupancy is resting right at 95.6% today. And for BSR, that's very strong. And that's about where we would like to see it, between 95 and 96%, wholeheartedly, just because that means you're pricing your units correctly. And as I was mentioning earlier, we've increased rents 8%. So in terms of the new leases, and 3% on renewals. And when you look at the dynamic of what's going on with the supply and demand, we're not concerned about, how much inflation is, everyone's talking between 2 to 4% inflation, and that it may be transitory. The bond markets have not been reflecting long-term inflation. So at this point, BSR, we're anticipating that we are going to see a spike of inflation in the market. We believe is anticipating that, but we are seeing some excise demand coming in for our product at this point in time, just as many of the aggregators and data aggregators have forecast. But I'll tell you that from a standpoint of renter migration, we've never seen as strong of a situation that we're going through today. And it may be because the pandemic helped promote additional renter migration, but we've consistently have seen this over the years, but not to the degree that we're seeing it today.
Yeah. And David, I think you asked about, this is important, we don't have rent control in our market, so we're able to reprice our leases at market. Each lease is between 10 and 12 months roughly, so at least once a year we have a chance to mark a lease up to market. And of course, we turn our apartments much faster as well than in Canada. Turnover on average in multifamily housing is 50% in the US.
Yeah, and then that's a very, very important differentiator, I think, between the US, particularly the markets you are in versus the Canadian, where the Canadian REITs are largely positioned. And maybe just another real quick one under the wire here. You've obviously been very successful in cycling out of non-core assets and into higher growth markets since your IPO. Going forward, what does the acquisition environment look like in terms of cap rates? And what's your acquisition outlook for the rest of the year?
Dan?
Yeah, sure, David. So the acquisition market right now is, I can't think of a great analogy other than just say it's hand-to-hand combat. Asset values, we haven't seen this type of appreciation, rapid appreciation in asset values in quite some time, if not ever. Now, with that said, BSR has a strategic advantage in the markets we serve, and that is that we can act quickly, and we are very liquid with our offers. So once we identify an asset that we like, we can execute upon it and acquire it and put the BSR flag in front of it within, I'll say, less than 25 to 30 days. That gives us a little bit of a competitive advantage against our competitors in this market that are using oftentimes agency, that is Fannie Mae or Freddie Mac debt in order to acquire the type of assets that we acquire. The timeline for those executions takes 60 to 90 days. So with that said, cap rates have never been lower, and for good reason. I mean, I think we started the conversation today by talking about how rent increases have never been higher. It's an attractive asset class located in markets that are some of the fastest growing markets in the United States that have been reopened for some time now. As it goes forward I would say between now and the end of the year, we've guided that we're looking to acquire about $200 to $250 million of assets. That equates to about 5 to 6 properties for us. We really see no impediment to filling the pipeline between now and the end of the year, if not sooner. It's just remaining active in our markets. As a matter of fact, we're all here at the office today. Our acquisition team is in Austin and Houston right now doing exactly that, with walking sites, looking at potential opportunities.
Okay, fantastic. John, Susie, Dan, on behalf of Echelon and everyone in attendance, I'd like to thank you for making the time to present to us today. And we look forward to following the story going forward. BSR trades on the TSX ticker HOM.U. And with that, I'll pass the mic to my colleague Amber, who will introduce our next presenter. Thanks.
Thank you very much. Thank you, David.
Thank you, David, and thank you, Susie, Dan, and John. I'm now pleased to introduce our next presenter, Mitch Barnard of Wildpack Beverage. The ticker is appropriately CANS, C-A-N-S, on the Venture Exchange. Wildpack is a co-packer focused on can filling, can decorating, as well as can brokering in the U.S. The company went public just a few weeks ago and is already showcasing tremendous growth, having finished 2020 with $12 million in sales. And they just reported a few days ago their Q1 2021 numbers, and they're already running at $25 million in annualized sales. With that, Mitch, pleased to have you with us. Over to you.
Yeah, perfect. I appreciate the kind introduction. And I look forward to the presentation and the questions at the end. So we'll just skip through the boring stuff into what we are. So Wildpack in a nutshell, it's a very simple story. We're a middle market beverage manufacturer, and our focus is really on serving brands that are everything from a startup all the way up to just the step before Coca-Cola and Pepsi. And we're really focused on filling a major market void with respect to capacity, and also building our business model around the actual needs of our customers. And so what we do is very straightforward. We fill, decorate, and broker aluminum cans. We're aluminum can centric. And what that really means to our customers is we do about 70% of the things that a brand needs to take their beverage idea from an idea to on the shelf. So we're kind of the quarterback that sits back part of their supply chain and makes sure that everything runs. We currently operate 3 facilities. The first 2 in Baltimore and Sacramento. They were both acquisitions. And we recently built, as reported in Q1, the Las Vegas facility. And our goal is to build a network of facilities over the next 24 months, such that we achieve appropriate saturation to limit shipping costs of finished goods and raw materials for our customers. And it entrenches a very strong strategic advantage for us and the people who decide to use us as their co-packing partner. So I won't belabor the capitalization. This is what we came out of the go public gate as. Our enterprise value now is hovering up in the 70 million range, a little bit higher than that at times. The only thing that I'll really talk about is two points on this. Number one, there's a lot of insider ownership in the company, and we heavily participated on the go public round. Obviously, all of that comes with traditional long-dated lockups, and we're a management team that's very, very focused on the future and the growth of the business. And the other thing that I'll say is, generally speaking, we're relatively unlevered compared to our growth rate and our assets. So we're currently sitting just under 5 million Canadian. That might change, slightly in the near term, obviously with what we announced today, but I won't go into too much detail on that. But the company has a very, very strong balance sheet and a very, very strong capitalization. From a management perspective, what you will see and what we've done now and what we're going to continue to do is you're going to see really 2 leadership teams being built. The first leadership team is the growth leadership team, and it's really the 4 founders, the first names on this list. And we are really focused on how we're going to go out and build and buy things to grow into our market opportunity. So, it's ex-securities lawyers, ex-M&A lawyers, ex-public accountants and CFAs, and Steve's a historic serial entrepreneur in the consolidation space. So really we're built to go out and buy and build things to be able to grow into this opportunity. And then what you'll see is a consistent trend of us adding depth at the operational level behind the growers, call them. So Chuck Zallo, we recently announced his involvement in the business, and we brought him in as the COO and moved Tommy to the Chief Growth Officer. And he has a perfect background for what our business is. He was a Coca-Cola turnaround specialist for their beverage plants, walking into underperforming plants, re-optimizing them and integrating them back into the system. He then moved to be the COO of Revolution Brewing, which is one of the biggest breweries in the US, and with a massive amount of analogous features to what we're doing. So he's really building that team up behind him. But you're going to see this trend as we continue to grow. Two real teams, one focused on growth excellence and one focused on operational excellence. The board of directors, exactly the same strategy. So we have a lot of depth in Sage. We know we're a bunch of young bucks out here running around growing this thing. And we want to tamper that with a lot of Sage and wisdom with the capital markets and large businesses. So you'll see a good chunk of our board is really focused on 20 plus years in the markets, 20 plus years and leadership positions, both as directors and officers of companies ranging from 100 million to a couple $1 billion market caps. And then you see, that countersink of growth-focused individuals. We have everything from ex-KKR private equity folks who really focus their entire kind of careers on consolidation, roll-up strategies, as well as entrepreneurs who have used the capital markets to continue to grow and again use those consolidation strategies. So we're really building out two distinct teams within the Wild Pack leadership that will work together to affect not only the growth story, but also the operational excellence we need to drive things to the bottom line and create the returns that we're looking to create on assets. So we always kind of go into a high level overview of the really important things in the presentation so that as I hit each slide and every trend, you can see how it plays into the bigger picture. So, to paint a very broad picture that we'll drill into in a little bit, demand for middle market beverage manufacturing services are, the highest that they've ever been, and they continue to soar. And, that was happening pre-COVID, and COVID really accelerated it. And coming out of COVID, we're seeing a continued kind of alteration in the way that humans consume beverages. And there's much more demand in the RTD space because most people don't want to go and even though things are reopening, go back and drink out of a glass that a bunch of other people have used. So RTD is growing at a ridiculous rate. Most of that growth is happening in the middle market with a bunch of new brands in the craft consumption ideology, and there's just not a lot of capacity available. Most of our competitors are single facility, single service owner operator businesses that can't really scale. So we're really stepping into the perfect landscape for a consolidation. And obviously being in the capital markets allows us access to the capital we need to grow and take over the market demand. As far as how we alter the assets after we either acquire them or build them, it's a light CapEx brush because the facilities we're building are running at a lot slower speeds than the Coke and Pepsis or Refrescos of the world. So we can step in, remove throughput roadblocks at a relatively cheap rate, which increases our return on capital and allows us to generate the returns that we're looking for on a facility by facility basis. The last thing that I'll say is, we're in a very archaic industry. It's a lot of, most folks kind of in the 30s aren't really focusing on building beverage manufacturing businesses like we are. They're off, looking at cryptocurrency or DeFi. So there's no true succession plan. And right now, the way the industry operates is relatively archaic in the sense that, the normal ordering processes, faxing POs, and so on and so forth. So we're at the forefront of building a digitalized solution to be able to, solve that problem for our customers and make their supply chain look a lot more like a Domino's pizza tracker than an archaic, faxing back and forth situation, which is very important because if you look at the avatar of a traditional, a CEO of a new beverage brand, they're a 30-year-old something millennial, venture backed that grew up in the Amazon era. So it's something that they're looking for in a partner and something that we'll be at the forefront of providing. So we've been exceptionally busy as a management team, and you'll see that we continue to plan to be so long into this year and beyond. So we acquired 2 businesses in June of last year. We went public in March. We built our first facility ground up in April, and we obviously finalized the go public and listed in May. So it's been a very, very busy, all the while we doubled the revenue of the facility that we acquired for the same period comparatively before we acquired it, which I'll talk about in a moment. But since then, we publicly announced we've obviously brought in the COO. We've entered into 3 LOIs for new facilities, which we're working through. And you're going to see that path play out. And on the other side, you're going to see internally, we're adding new lines in our existing footprints through our staged upgrades to be able to increase capacity and throughput within our facilities to service more of our backlog of demand. There's a substantial backlog that continues to grow because there's so much demand and such a lack of capacity. The other big things on the horizon for us that we're talking about, we're not giving you a ton of guidance on the specific things that we're doing and what the economics of those look like, but we're going to be internalizing certain processes that are currently outsourced. And like I talked about, the plan is to get the digitized ordering process in place before the end of the year. So moving to the industry and the market dynamics that are really creating this mega opportunity for us. The first thing to talk about is the basis of our entire business, which is the aluminum can. So we went out kind of ahead of COVID, throwing the entire supply chain underwater far deeper than it ever has been in the history of its existence. We went out and signed significant contracts with international providers to service what we had modeled out our demand to be over this year. And at the time, that was a relatively faux pas thing to do in the United States. Most people wanted domestic can supply, which is very problematic for the middle market because the way that the major can players operate is they sign contracts with the big players like Coca, Pepsi, Diageo and the like. And then they sign allocation arrangements with middle market players, which basically means that they can cancel their orders whenever they feel like it. So that doesn't work when you're solely dependent on the aluminum can. So obviously we went out and we found other avenues that got us to a very similar price point to as though we were buying domestic supply. We did the QA to make sure that everything worked with all of our customers. And we've been taking delivery under those contracts now for 5 months, no issues. We've had a very smooth supply chain and most of our peers are currently underwater with no access to cans. Those contracts allow us to move into next year as well, which is a great advantage. And at that point, we'll be large enough that we'll probably be able to move into more contractual relationships with domestic suppliers to basically isolate our long-term advantage, which is the network. So we're really leveraging our near-term advantage of cans during a shortage now to build our network. And then once our network's in place, that'll be our long-term strategic advantage. So kind of already talked about this, but we're in the greatest can shortage in the history of the world, frankly. Traditionally what you would see in a non-COVID universe is throughout the winter, the domestic suppliers are really selling all of their cans at a 95 to 100% utilization basis. And then in the summer months, you see demand spike. They go underwater 10 or 15%. And then obviously in parallel to that, cut off the bottom 15% of their customers from allocations. And then you start to see a normalization occur following the summer. An equilibrium occur a few months after that, and then you have 2 or 3 months of everything's normal, and then people are ramping back up for summer. So middle market beverage manufacturers and middle market beverage brands start to get cut off in the summer months when they need access the most. When COVID hit, obviously we saw a massive acceleration in the consumption of RTDs for good reason. All of the tap rooms and bars were closed. And there was a lot of people theorizing what was going to happen on the other side of that. And what we've seen is that consumption ideology has changed. So when people are opting more for a single-use container situation, and when you layer that on the already growing RTD before COVID, the already growing move of new brands from other container types into aluminum, which we'll talk about in a moment, the supply chain just can't keep up, and the speed at which these facilities can turn on, the can manufacturing facilities, is slow. That when you model it, we're going to be underwater for a very long time. And Ball, Crown, Ardall, the big players in their most recent earnings calls are already talking about when they think normalization will occur well into 2023. But we have access again, which is one of our near-term advantages. So we briefly touched on this, so I won't highlight it too much, but the RTD space was growing ahead of COVID and is anticipated to continue to grow well after, obviously with COVID being an accelerant in that, even after reopening as consumer consumption patterns have changed. The biggest thing for us is really the cross-section of where we do business is the place that's growing, and new brands are launching in aluminum containers for all kinds of reasons. It's cheaper to ship. And I think predominantly one of the main focuses is really ESG. And, we share that with our customers. We're inherently a very environmentally focused business because, we only operate in the aluminum can space, which is the most recyclable of all container types. So we have an inherent there. We also obviously are working towards ESG assurance level, things with respect to sustainability within our facilities with, electricity, water, because we are a large user of both. But on the demand side, if you look at our customers, it's very, very similar. Like look at Diageo or Coke and Pepsi or any of these big companies, and they're making commitments to ESG within the next 5 years that really can only be achieved if they're moving most of their product offerings into aluminum cans, which for us is, we're seeing that on the demand side, and the market's been seeing that for a while, and it's continuing through the reopening, which is obviously, a very strong thing for our business as well. The last thing that I'll touch on from a macro trend perspective, we've already spoken about the fragmented bottom in our competitors, but something else that's really driving demand for us is the big players in the co-packing space, like Refresco, are buying up the top end of the middle market, single facilities, increasing their line speed, and then really pushing out their smaller customers because they're on a let's run one SKU as long as possible and not change over model, whereas we're a much more flexible co-packing partner that anticipates significant changeovers because that's the size of the customer that we're trying to work with. So what we see is a lot of very, very large customers from our perspective pushing down into our market because they can't find capacity at the top end because the minimum order quantities get pushed so large. So you're really just blowing up the exact cross section where we do business. Again, another major macro trend and why we're so hungry to go and build more capacity, more facilities, because even though we're sitting at a cross section where there's significant demand relative to capacity and our backlog continues to grow, we think that the macro trends are really blowing over the near to mid-term in that direction as well. So what are we going to do? And how are we going to take advantage? And the answer is we're going to build a lot of things. We're going to buy a lot of things with a slight lean towards buying, which we'll get into in a moment. So we're a consolidation strategy. That's what our business is. It's what we've talked about in all of our investment presentations, and it's what's disclosed within all of our public disclosures. But really that can happen in two different ways. So we've done both now. So I can talk about what they look like to us. So the Sacramento and Baltimore acquisitions, the easiest way to think about it is that in the 6 months after we bought those companies compared to the 6 months prior, we doubled their revenue. And how you do that is you assess the weak points in the throughput of their manufacturing lines. You deploy some light capex, remove those, build some systems around how those facilities operate, give them a better back office, and things start to ramp off. So you can see it in this chart. In August is when we downed the facilities to make a lot of the changes. We did a little bit more in October, and then things start to escalate. And that's a trend that we look for when we're looking at acquisition targets, is when we're buying a company and valuing them based off specific EBITDA targets, it's, well, what can we do after? What does the next 12 months look like? What's the staged upgrades look like? What's the CapEx required? What's our return on capital? Does it make more sense than to buy things? In many circumstances, almost all that we're looking at right now, it does. Build things, I meant to say. We've also built, and our cost of building is quite cheap and modest at $2.3 million. And we can build those in about 5 months. So for us, the real way to look at, well, how are you going to grow, is we're going to be opportunistic within our geographic focused ideology. So we know we need to be in very specific geographic locations in the US, up to about 12 facilities, to hit the right saturation number to drive down shipping costs for our customers, which in turn provides a significant benefit to them and thereby a strategic advantage, competitive advantage for us as a partner. And so we need to be in those locations. So what we do is M&As we typically do a little bit better on a cost perspective. So we look for facilities that make a lot of sense. We do a deep due diligence. If they make sense, great, we'll move forward. If not, we'll build there. We publicly announced recently 3 LOIs that we're looking at. We have a very deep pipeline of potential opportunities. So that's really the approach that we're taking on how we will grow. So we're not giving any guidance on what we'll do this year. Obviously, we're growing at a rate that it would be relatively imprudent to do so. So just from an illustrative perspective on a 4-wall EBITDA basis, our facilities will generate strong EBITDA, and then obviously we do layer on overhead from an SG&A perspective on top of that. But on scale, things look very, very strong. And just to put it in perspective, we're currently burning through 10 million cans on between our two major segments being decorated and filling right now, which we released in our most recent MD&A. So these numbers aren't all that unreasonable, and the scale that we're talking about is not that far off. But if we're able to decorate 120 million cans, and if we're able to fill 4 million cases, we end up, north of 12 million of EBITDA. So there's strong margins on this business on scale, and really we've built our our back office to be able to operate 6 facilities as we sit today, and as was reported in our Q1s and described in our MD&A and our press releases. So we're very excited for what the future might look like. As far as the acquisitions and what the kind of boiled down simplified economics look like, our goal is to always buy things at a substantive discount to what the public markets are going to trade those cash flows at, or those financial metrics, I should say. We're often, because most of the companies we're looking at are very similar to us, they're full capacity well through 2020, through 2021 and into 2022 already. We're obviously valuing most of them the same way that we're being valued, I believe, on multiples of 2021 revenue and EBITDA. We bought at very, very attractive multiples in Baltimore and Sacramento, but had to do a very aggressive overhaul. We're looking a little bit further up the chain now at companies that are positive EBITDA already, but still have a significant throughput ability if we make the right changes. And we're looking at buying those at around 6 times next 12 months EBITDA. The markets are trading those on an average basis far higher than that. As far as how we're breaking out the consideration on those transactions, we're always trying to weight equity and debt to get to strike a nice medium where we're incentivizing long-term growth of that facility and those owners with payouts that people are happy and all the right incentives are in place. The interesting thing to note is most of the facilities that we're looking to acquire are either underlevered or not levered at all. They're owner operator, they've all been pulling a strong salary, and most are afraid of leverage. So there's a lot of opportunity for us to use those cash flows to obtain additional leverage, which should chunk into that equity component. So you basically end up in a light leverage buyout basis on the cash side, which again is very attractive for us on a returns basis, which makes the M&As a very attractive way for us to grow. Our team is built around it. Like I said earlier, we have M&A finance guys on staff that this is all that they think about. So this is a very good way for us to build our footprint, and obviously we've announced that we're undertaking it right now. I won't belabor this point because multiples are multiples, but we are still, as a very new story, trading below what the averages are on a go-forward basis. Obviously, we're not giving a ton of guidance, so it makes some sense. But as we continue to, and I think that Amir laid it out, if you just quantify out what our most recent Q1s were and you assume no more growth, we're still trading at a relatively modest multiple. And when we continue to prove our story, prove our strategy, we think that things will trend in the right direction. So we're pretty optimistic about what the future has. So that's the end of the presentation. I'll pass it back off to Amir and open to any questions.
Thanks, Mitch. As a reminder, we encourage you guys to ask questions through the Zoom platform. I see we already have one, or you could email me as well. The question we have on the Zoom platform, Mitch, is what are the size of the cases for the slide 20 metrics? I think they're 24
yeah.
Ounce.
Yeah, 24 12-ounce case equivalents. Yeah, that's right.
Great. Okay, maybe I'll kick it off. Mitch, you spoke to a very constructive industry backdrop with the growth in RTDs notably. Can you give us more color on the shortage of cans in North America? The growth in RTDs isn't anything new. Are there any other drivers that we should be thinking about? And with, I guess, COVID subsiding south of the borders, what are the early trends you're currently seeing?
Yeah, no, 100%. And I mean, so yeah, RTD's been growing for a very long time. It's nothing new. We see it everywhere. I think what's the real change that's been occurring is the speed at which brands are moving away from other container types and into the aluminum can. So you layer that on top of the acceleration that COVID did to the RTD space, generally speaking, and you take a supply chain that was on the edge at the best of times and put it 20 or 30% underwater. And then you layer on the time it takes for can manufacturers. So think about it, right? You have the growth that's already happening. You've now took the deep end and put it 20% deeper. And then you look and you layer on, well, how long does it take can makers to build new facilities? 2 years is really what 18 months to 2 years. how long does it take to just reach back to, and crest meeting the normal growth? So I think that's really what's driving the can shortage, generally speaking. Obviously, COVID threw it under for a loop. But as far as early trends go, we obviously operate our business as really an early indicator of what's happening in RTD, because we're planning production for RTD brands for the next year, right? So we're looking, and they're making their plans based off consumption data. And we were all looking very eagerly, about 3 months out from when we thought reopening was going to happen, of, well, what's going to happen? Are people going to go back to the bars and they're not going to drink single serve, and, RTD is going to slow down? But we've actually seen an acceleration, which, in our estimate is largely due to the fact that consumption's changed and people are going to more likely choose a container versus a glass. And, we think that'll continue. And we think equilibrium is, in line with, I think, what the can makers are saying in their earnings calls and putting out in their MD&As, of, 2023 kind of being the earliest that there's an equilibrium between supply and demand of the aluminum can, which again, I'll say is largely, when you look at it historically, even in good years, in the summer months, still underwater. So.
All right. I've got a couple by email that I'll try to consolidate. So what's the rationale of a decentralized network strategy relative to driving operating leverage through larger facilities? And the second question, which is sort of related, you spoke to shipping cost savings.
Yep.
Maybe you can give us more color on how much savings are there for your clients, and how your pricing would be differentiated from competitors.
Right. So I'll actually start with, and I think the right place to start is at the end. So our pricing is market to the middle market. So to our competitors, people that are operating in the same space, the same run sizes we are. It's very premium to what Refresco is charging, running at 2,000 cans per minute. But again, they can't service these customers because the units of loss would be too large, because the speeds, the lines run too fast and they wouldn't shut them down, right? So we're on market with respect to our pricing in the middle market. But moving back to the beginning, why decentralized? Why a network versus a more centralized approach? And the answer is really in what you described, the economics for our actual customer. So if you look at their contribution margins on their beverages, and we had an interesting insight into this, is because we came from the consumer packaged goods space. Their gross margin will fluctuate between 10 and 15% if they have to ship across the country. So it's a significant impact to our customers relative to if they can get into one-day shipping. And one-day shipping is really a 300-mile radius from wherever the end distribution location is. So the way the beverage market typically works, generally speaking, there is some direct-to-retailer stuff, but the big players, you have the ingredients hit our co-packer. The co-packer does what we do. We put it in a can, we put it in a finished good. You have a pallet that's done. And then that gets shipped to a distributor. The distributor then ships it out to all the retailers. Those distributors, those DSs, are kind of scattered across the country in all major sectors. So we want facilities within all of those kind of major sectors within 300 miles. So we've specifically built out a model to determine where the right locations are. And we need about 12 to hit the right saturation. And then we can, give our customers who are paying the same rate as they would be paying at a centralized location, the added advantage on their contribution margin, to be able to ship less. And for us, that's great because it entrenches the longer term relationship. But obviously, the better they do, the better we do, and everybody's happy. So I think that generally answers your question.
Yep. We're just like one last one that I'll take from the platform. You guys have some sort of target internal IRR, or how do we think about return profile of building versus acquiring?
Yeah, so for us, we don't get into IRR per se, but we're typically looking at, when we buy facilities, what's the EBITDA that they're going to put off, and what's our time frame on returning the capital that we deploy, whether it's through buying the company and upgrading it, or building right out of the gate. And we're looking for sub 24-month return on an EBITDA basis is typically speaking what we're trying to see. Obviously, we prefer and have been, based on what we've been doing so far, things that are far better than that. But that's the general metric that our team's looking at. And there's a lot of different things that we're assessing when we're looking at acquiring companies. For example, some companies come with existing CAN relationships, right? Some companies come, tightly knit with a certain customer base. So we're really assessing, and those models are being refined based on the specific entity. But from a general perspective, we're looking to take companies that we can return our capital on an EBITDA basis within less than 24 months.
Great. Thank you, Mitch. We still have like a few questions, but we won't be able to go through them. That was evidently a great presentation and intro to a new, an exciting public company. With that, we'll pause for a few seconds while we queue up our next speakers, Rob Goff, our head of research, and Converge. Rob, over to you. Rob, you're on mute.
It should be good now. Can you hear me, Emma? Awesome. Okay, I was just saying I was going to give it a minute for recording purposes, but that has been taken care of. We are very excited to have Sean Main, the CEO of Converge, here along with Carl Smith, their CFO. Sean and his team have put together a remarkable track record of 19 acquisitions since the third quarter of 2018 in building a 1.5 billion run rate company. We are very bullish on both the organic and the inorganic growth outlook for the company, believing it is poised to build on its success. We are still in the early to mid innings. There's a lot more room here to grow. Our report headers typically have something to do with copy, paste, accrete, repeat, price target raised. We look forward to doing many more of those as the company has a long runway. We did want to highlight that the shares of CTS are at roughly 873. They're pushing their 52-week highs of 877. They have returned a remarkable 76% year to date and an even more remarkable 573% over the past year. Now, I'm very pleased to hand it over to Sean. Welcome.
Thanks, Rob. Appreciate it. So Converge, I believe is Carl driving? Can we get to the third slide, please?
Yeah, that would be Mohammed.
Oh, Mohammed. Oh, excellent. So thank you, Mohammed. So Converge Technology Solutions is a company that is the fastest growing IT service provider in North America. And we're very proud of that fact. We have grown our adjusted EBITDA by 90% plus every year. So each year since we were founded 3.5 years ago. We recently gave out our Q1 results, which again did that. We grow through acquisition, but really the key growth for us is on the recurring revenue side. And we were thrilled to recently announce that Thomas Volk, who used to run a company called CanCom, one of the companies that I have modeled our managed services strategy after, who left CanCom as their CEO last Q1, is now our chairman. Converge, last year, we buy companies with debt and working capital, so we don't require equity to buy companies. So we entered last year as a highly leveraged company. We, last year, raised $200 million, took $20 million cost up by integrating the back offices, moved our ABL from 9% down to 2.5%, bought 5 more companies, and the results that we continue to produce will be grown by our expansion into Europe now. So we're incredibly proud of what we have accomplished, and thank you, Rob, for kind of outlining those. We announced a $172.5 million financing last week that we did. We now have an incredibly strong balance sheet, which will allow us to enable an aggressive growth strategy in Europe as well. Next slide, please. So you'll see that Converge, when I set out the strategy for how we would develop, I wanted to hit all of the NFL cities in the US because that's where our customers are. And this map shows that we've done an incredible job of doing that. We're not all the way there yet. So if your favorite NFL team is not represented there, then hopefully we'll be there soon. We also are getting an incredible amount of recognition from the industry. At IBM Think, we are IBM's #1 growth partner in North America on the software side. People might think of IBM as a dinosaur on the hardware side, but on the software side, they're world-class on things like analytics and some of the high margin services that we provide. We're the fastest growing IT service provider in North America. We're also we've just been released from the 50th largest to the 39th largest, which tells you there's very few large partners and a lot of very small partners. Next slide, please, Mohammed. We buy companies that provide digital infrastructure. That's hardware, software, services, and data centers. And then we change them into companies that provide advanced analytics, cybersecurity, cloud, and managed services. You can tell how we transition these companies through our gross profit percentage. Next slide, please, Mohammed. So we buy resellers for 5 times EBITDA because they're selling into the data center. We turn them into a much more valuable cloud and managed service provider enabled by Red Hat and VMware. They have something called Kubernetes implementations that allow an application to not know where it exists. So you can put them on the public cloud providers, of which Microsoft Azure is the best one for Windows applications and front office applications. AWS and GCP are better for back office ones. We have our own managed services, which is our highest gross profit percentage offering, where we host applications on behalf of our customers. And then during the pandemic, our VMware managed services like VMC on AWS were great sellers, allowing people to access applications remotely in a secure fashion. Next slide, please. So when you look at the IT services space, the way you can tell us apart is you look at our gross profit percentage. The people that sell hardware, and there's some great ones like CDW and Insight, make between 13 to 16% gross profit. In Q3 last year, we had over 27% gross profit, 7% EBITDA, grew to 8% EBITDA in Q4, which means I look much more like a global SI, an Accenture, CGI, than I do like a reseller. I buy resellers and I transition them into a consulting cloud and managed service provider. Next slide, please. So this 3-phase plan, I'm very kind of sentimental about. I'm very proud of. I created this plan in April of 2017. This year, we complete this plan. We will be over 2 billion run rate revenue. We're at 1.5 billion now with a bunch of acquisitions, and over 100 million of EBITDA, which we're at now on a run rate basis. Phase 1 was create a broader geographical coverage in Canada, US. Phase 2 was build up those capabilities around hybrid IT. Phase 3 was take the cost out and scale. We took 20 million of cost out last year. I will, on June 23rd, be presenting our plan to go from 2 billion to 5 billion in sales in 4 years. Next slide, please. So we are operators, but there is a financial engineering aspect to the company. I do not require equity to buy a company. On average, a hardware-centric VAR makes 3% EBITDA margins. So per 100 million of sales has 3 million of EBITDA. We pay up to 5 times or 15 million of purchase price per 100 million of revenue. We structure the deals so that 50 to 60% of that is upfront. Call it 9 million of purchase price upfront, and then 6 million over a 3-year earnout. We buy them cash-free, debt-free with normal working capital. So there's a clean balance sheet. We use our asset-backed lending facility, our ABL, to finance their invoices and inventory to hand them the check for the $9 million. We have not used any of our own equity to hand them that check. And then we use their own profits to pay the earnout. So no equity required. Then because they're small, they receive payments from their customers on 54 days, but have to pay their suppliers on 45 days. The day after we acquire them, Ingram Micro gives me 75-day terms, which means per 100 million of revenue, I surface 3 million of cash, increased payables and increased cash, reducing the 9 million of debt I had up front to 6 million. And then, so I bought them with debt and working capital. I moved their EBITDA margins from 3% to 4.5% through volume rebates. That's the way that IBM, Cisco, and Ingram reward partners who are larger. I then last year took 2% of cost out, 1% from the back office, 1% from the front office, moving us to 6.5% EBITDA margins. And then through cross-selling, higher margin cloud and managed services, I can get my EBITDA percentage up to 9%. I can get my gross profit up to 30%. And again, last year, when we didn't do acquisitions, you saw that in the numbers. Next slide, please. Converge buys 4 to 6 companies in North America per year. We bought 2 in 17, 4 in 18, 5 in 19, 5 in 20. We've bought 3 so far this year. In addition to the companies we buy in North America, we will start acquiring very soon companies in Europe, focusing on Germany and the UK. Talk about our European expansion. I focus on companies that drink beer, like Germany, UK, Benelux, Nordics, and Ireland. And you avoid companies that you want to go on vacation, but the ones that drink wine, France and Southern Europe. The problem is you can't integrate those companies effectively. So you should hear more about our German strategy very soon. Next slide, please. Converge is really good at doing 2 things that most companies really struggle at. We're great at cross-selling. We're great at integration. Last year, I took 20 million of cost out by integrating the back offices of the companies I had acquired so far. In March, we took out 8 million of additional cost by integrating the companies I just acquired. And here's the schedule for migrating their ERP systems to a common system to take additional cost out. You see it in our numbers. We are fantastic at doing this. Next slide, please. So Converge's market is the mid-market and the upper end of the SMB space. Most companies like CGI, Accenture, et cetera, only focus on the 150 billion large enterprise space. We focus on the 650 billion mid-market space and the upper end of the 400 billion SMB space. Call it 800 billion of total addressable market. That means our revenue is 1% really of our total addressable market. When you look at the sectors we sell into, we've got in Q1, it was 22% in government, 25% technology, 13% in financial services, 12% in healthcare, 6% in manufacturing, an increase in retail to 9%, showing the comeback, and 13% of other, which no one sector makes up more than 2%. Our top 10 customers make up less than 20% of our revenue. So wonderful, diversified customer base. Next slide, please. The most valuable revenue we have is our recurring revenue. And of that, our managed services revenue is the key part of that. So in Q1, on an annualized basis, we had 64 million of managed services revenue. These are 3-year contracts paid monthly that we make over 40% gross profit to. We target that sector to get to 100 million of revenue by the end of the year and 50% of gross profit. We sold 75 million of public cloud resell. That's Amazon, Google, and Microsoft, where we're reselling their service, but we only recognize that revenue as net. I invoice 75 million on a year. I recognize less than 10% of that because they provide the service. And then because we sell around a quarter of our revenues software, this software annual piece for patches and upgrades is 54% of my recurring revenue. So 305 million of annualized recurring revenue nets down to about 115, 120 million in my net revenue, but that grew from 190 million. This is a key component of our organic growth and most valuable revenue we have. One of the reasons we are the fastest growing IT service provider in North America is we excel at cross-selling and net new logos. We have the highest net new logos in the industry. In Q4, we had an incredible 71. We beat it even in Q1 at 80. These are customers we have never sold to before that we are getting revenue from the first time. How do we do that? One of the key ways is our vendors partner with us to hold technical workshops, such as Red Hat's Ansible and OpenShift, where we'll go into a region, a city, and invite mid-market customers to come to us. Large enterprise customers will not come to you, mid-market will. And last year we saw over 400 customers. Our executive briefings where our executives invite, come in to talk about the capabilities we have. We buy companies. Those people don't know that what we can do, but if they bring an executive like Greg Barnard, our president, to talk about our managed services, our DevOps, our cybersecurity and managed services, these are how they can highlight the capabilities to allow the cross-sell. And as I mentioned, our recurring revenue grew 61% year on year. Next slide, please. So actually hand this over to Carl Smith, our CFO, to go through our financials.
Great, thanks, Sean. So this is a really good snapshot of our growth from FY18 to FY20. Our revenue increased 38% to 950 million. Our gross margin increased to 24.6% from 23.5% last year and from 19% in FY18. And it's that expansion of the gross margin that really demonstrates the organic growth coming from our higher margin cloud and managed services. As Sean mentioned, our EBITDA increased 91% to 60.5 million. And as a percentage, it increased to 6.4% from 3.6% in FY18. And EBITDA is a really good measurement of free cash flow for us. We're not a high CapEx company. We don't require cash for working capital. In fact, working capital is a source of funds for us. We get paid from our customers before we pay our suppliers. So when I look at my EBITDA, about 70% of that turns into free cash flow. And while we don't provide guidance, I do have 8 analysts following us, and consensus on the street is $100 million of EBITDA this year and $1.5 billion of revenue. And that's based on the acquisitions that we've done to date. Next slide. Our Q1, great quarter. Our revenue increased 28% to 310 million. My adjusted EBITDA increased 70% to just under 19 million. And as a percentage of revenue was 6.1%, up from 4.6% last year. Next slide. I have a very strong balance sheet. This is as at March 31st. As Sean mentioned, at the beginning of FY20, we started the year with a really highly leveraged balance sheet. We had expensive debt. We were paying about 9.5% interest. We were about 5 times EBITDA. We're quite comfortable with that. We have really good visibility into our revenue, and certainly as more of our revenue is coming from recurring, we have even more comfort with our ability to generate cash flow. But last year, at the start of the year, we were highly leveraged. We were probably about 90% retail shareholders, and we had very expensive debt. If you look at where we are today, we have a low leverage balance sheet. In fact, we're probably under levered. My debt cost is now down to 2.5% interest as opposed to over 9. I'm going to save over $10 million of interest costs this year. I had $68 million in cash at the end of March, 49 in restricted that was held for an acquisition we closed on April 1st. I had 140 million drawn on my low-cost ABL, and then just recently, Last week, we closed another $170 million equity financing priced at $750. So we're well capitalized for our expansion into Europe. Next slide. Our share capital summary, this is slightly out of date. There's about 188 million shares fully diluted now as a result of the raise. That is a fully diluted number. There are no options and there are no warrants outstanding. Management owns about 9%. Each quarter, the executive team and the management team, we use portion of our variable compensation to buy shares in the open market. So we're constantly increasing our ownership in the open market, and I think we're fully aligned with our shareholders. Next slide. And I'll turn it back to Sean.
Thanks, Carl. So the team that has done this is an incredible mix of people that I've known for a very long time and people that have come through the acquisitions. So Gord McMillan, our chair, I've known since I went to Queens as Don Cuthbertson, our CTO as well. I've known since the late 80s. Gord is exceptional at getting acquisitions from LOI to close. Don sets our technical direction and he runs Canada for us. Corey Reed, our COO, who I started my first job with at Bell Northern Research up in 1992, he's the one responsible for all the integration of the back office, the 20 million we took of cost out, the 8 million so far this year, and the rest. But Carl Smith, our CFO, only joined us in March of last year, and what a super job he's done in our analyst coverage, equity raises, moving the ABL, done a super job. Greg Barnard, our president, came out of the Lighthouse acquisition and runs all sales, marketing, and engineering. And he's the one responsible for all the cross-sell. Kerry Hash and Tommy Watley came out of my last consolidation and do a super job in enterprise sales and services. Denis Patel came out of IBM. Great job on the Red Hat partnership. And then Rhonda Haynes came from the first acquisition. I got to say, what a super job in this changing time, keeping all of our employees safe and yet meeting all of the requirements around COVID. She's done an amazing job. This team last year, so we started last year as a highly leveraged company in March facing COVID. We cross-sold, we integrated all the companies. We took 20 million of cost out. We changed the ABL from 9% to 2.5%. We raised 200 million of equity and bought 5 companies. This was a pretty incredible team. So that's all I got, Rob. So any questions would be great.
Awesome. Thank you, Sean. Given the conference here, one of the themes is leverage to a post-COVID economy. COVID has represented both tailwinds, but headwinds in the form of challenges, particularly in the managed services. Can you talk about how you see things unfolding in a open access economy with an economic rebound in North America in particular?
Absolutely. So last year, our Q1 was inflated slightly by people pulling spend in from Q2 into Q1 because they wanted certainty of delivery. Q2 was heavily impacted by COVID, including New York. Even though we grew, we were impacted. This year, even though our Q1 was very good, our Q2 year on year will be very different because of it'll be a normal year, which is normally stronger than Q1. And then we see all the coming back to work in the US. 75% plus of our business is US based. So you would expect to see, as the fastest growing IT service provider in North America, exceptional growth, especially in Q2 and then Q3, because of the impact that COVID had last year. Even though we grew, we didn't grow at nearly the rate. What did grow was the managed services revenue, the remote revenue, because as people move there, you will continue to see us invest heavily in that area and grow that. As we've said, we're in the low 60 millions of annualized revenue in managed services. We aim to get to 100 million by the end of the year. So you'll expect to hear a lot of that.
Cool. And in terms of talking about tailwinds, headwinds, could you talk about your relationship with IBM, what that means for you in Europe, what that means to you in terms of IBM changing its model for distribution partners.
So IBM made a big mistake about 7 years ago, and they decided to reward partners that only sold IBM, right? So they don't have that platform. So it meant that all the Cisco, HP, and Dell partners moved away from IBM and didn't sell any. IBM excels at software. So Watson, QRadar, Red Hat, these are their stellar products. Last year, we grew our software portfolio with IBM by 22%. 35 to 40% of our revenue came from IBM. And they are diversifying their group, spinning off the group that used to compete with us July 1st. It is a massive boost to us. We had 50 million of volume rebates, 18 million of transactional rebates around software last year. So it is incredible. We won 5 awards at IBM Think, the most of any North American partner. IBM Partner of the Year, Red Hat Partner of the Year, Analytics Partner of the Year for the 3rd year running, Identity Partner of the Year, and a Services Partner. Sirius, who's the largest partner, we're the 2nd largest, is declining in IBM revenue. The top 6 partners, we were the only one that grew. So Mainline used to be 3rd, et cetera, don't have our position. And our managed services around IBM's platform iSeries is a major growth area. So yeah, you would expect us to be in the kind of shock and awe kind of territory around IBM this year.
Okay. You have a clear track record of success in North America. How do you pick that up, and how does that translate into Europe, into the UK? Are some of the structural advantages that you have leveraged in North America available to you as a relative newcomer to that marketplace?
So the wonderful part is, yes, having been such a big growth partner in North America, like I think every single vendor partner that we've dealt with has either got a promotion or bought a house. So they've done very well, and they would love to exceed that in North America. But I can't say how proud I am and how privileged I feel to have Thomas Volk join us as chairman on June 23rd, assuming the shareholder vote goes ahead. Thomas was the CEO of CanCom. The company, if you go back and look at the transcripts, the company have always modeled around managed services as the person in Europe who got it right. Ran worldwide sales for HPE, ran Dell, UK, Germany, and France. Royalty in the technology industry in Europe. He's now our chairman, but not a non-exec. He works for us 2 days a week. And then the companies that we're targeting buying feel privileged to talk to this guy. So in this fragmented industry, I mean, look what we've done. But now with Thomas, yeah, it's pretty special. We announced Doris being hired, Doris Albiez, who ran channels for Dell before that IBM. I met with 64 companies, short list of 16, 4 under NDA. You'll hear stuff soon. We got cashed up for a reason. There's not, why did you, take all that equity on board? There's a reason. And yep, I feel so honored to have Thomas on board, and I can't wait to showcase what we can do in Europe.
In terms of the European model, would it be reasonable to look at valuations around 7 times EV to EBITDA? Is the working capital extension available to you in the marketplace? And how are you positioned as a preferred buyer in that market?
So it's all about growth rate. So if a reseller that doesn't have cloud grows around GDP growth rates, you can buy them for 5-6 times. Absolutely in Europe as well. There's a company we're looking at that grows at 100% a year. You're not going to get them. Now I'm very cheap, so I'm going single digit growth, EBITDA multiples anyways, but having Thomas and Doris on board for the German companies, the vendors, the help, what we've done so successfully in North America is get the vendor support. When you talk about working capital terms, having Ingram Micro and what they've done for us in North America, eager to support us in Europe, to have IBM and Cisco and Dell eager to support us. Thomas The CEO of HPE, Anthony Neri, worked with Thomas when he ran worldwide sales. I mean, we are in a fragmented space. We are so fortunate to have the people we have at the table. We have done an amazing job in North America, and we haven't hit Europe yet.
Cool. And one of the questions that come in, how quickly can you realize synergies after acquiring a company?
So in North America, it's all first year, right? So we get rebates first 30 days, synergies first year now. In Europe, the first companies we will not realize the front office synergies for the first one. 2 to 10 we will, because you need certain in-country requirements. So the playbook is back office out of Ireland. So all the synergies happen there. You know, the technical Eastern Europe, you'll get those. So we'll get those synergies, but on the first platform acquisition per country, you won't do those in Europe.
But I think there is some question with respect to Bechtel. How can you beat Bechtel in terms of making an acquisition, and why would a target go with you perhaps ahead of Bechtel?
That's a great question, because Bechtel's bought 100 companies in Germany. And I thought, oh my God, they must have picked over everybody. But when I went there, I realized, one, they don't integrate the back office, but any new customer coming in, they give to their top 12 companies. The companies I talked to, none of them want to be bought by Bechtel, because they know if there's new white space, it'll be given to someone else. So I was amazed at how many companies are available. CanCom, after losing Thomas, is kind of drifting and going south, so they don't move up by them. So with Bechtel and CanCom there, I was amazed by how many high quality companies in Germany I'm able to acquire.
Cool. And one final question, if I can. You did indicate that at the AGM, you would be talking about a revised version of your targets, looking at, I believe it was 5 billion in 4 years. Could you talk a bit more about the cadence of acquisitions in both the UK and North America underlying those ambitious targets?
And so 4 to 6 a year in North America is sustainable, at least for the next 3 years. So that plan will start January 1st next year and go for 4 years post that. We're very comfortable with the 4 to 6 a year. We gave the guidance of 400 million Canadian on those. It might be north of that. I believe we can do, but I haven't bought anybody in Europe, but I believe we can do the same cadence in Europe, and they'll be larger. So we'll be at more the midpoint. So again, we believe that 2 billion run rate with acquisitions is possible by the end of this year, and then add the North American piece with the same kind of 4 to 6 in Europe, and you'll get to kind of that billion-a-year number.
Oh. Well, your ability to deliver on your original plans, which appeared very audacious at the time you came out with them, gives investors a lot of confidence in your ability to deliver again. So I would like to thank Sean for being here today. Carl, I would like to thank you. And then we will pass it over to Simon, our Managing Director, Head of Sales and Trading. Sean, Carl, thank you. And Simon, over to you.
Thanks, Rob. And say hi to Robbie for me, because Robbie's been a great supporter of us. I love talking to the guys that have seen us execute the strategy when they heard about it really early.
I think Robbie
thanks for that, Sean. Yeah. Good afternoon. Thank you, everyone, for attending today. I'm Simon, the Head of Institutional Sales and Trading here at Echelon Capital Markets, with some closing remarks. It's been a unique 18 months, no matter where you live or in which sector of the economy you're operating. Companies have clearly had to adapt or face potential loss of revenue or even closures. But those companies that have adapted were nimble enough to pivot their workforces, product or services. The results have been outstanding to date. But it's not been without its challenges or unexpected disruptions. You just need to look at the global semiconductor shortage for 2021 to see some major risk factors still prevalent. Yet we wanted to focus on the positive momentum building for companies post-COVID and what that would look like. How would innovative companies such as those presenting today handle potential disruption while still outperforming in a strong growth market? And hopefully today's conference gave you some insight into the different sectors and how these companies are tackling these opportunities and challenges. Thank you to all the presenters. We're big fans of all these stories today. Lastly, thanks to our award-winning head of research, Rob Goff, and head of Quebec sales, Pierre-Yves Therese, for putting on a conference that highlights great potential for investors in the months to come. In 2020 and 2021, Echelon Capital Markets has itself innovated and grown, becoming second in the capital markets non-bank league tables in Canada for independent brokers in 2021, number 1 for wealth AUM growth in Canada, and for achieving 2 top 5 rated Canadian analysts as ranked by TipRanks. Thank you for attending. We'll be providing videos of the conference on YouTube in the coming days. So if you missed something, please feel free to check our channel. We have research on the majority of presenting companies here today, so please reach out if you want to talk to our analysts or access our research. So thank you for attending and have a great afternoon. Over and out.
Thank you, Simon.
Thanks, Simon.
Thanks,
Thanks,
everyone.
July. Thanks, everyone.